2016. It was based on various discussions that we had between us, Bahrain Development Bank, and the Economic Development Board in regards to how we can further build the startup ecosystem here in Bahrain. And one of the main elements and the pillars for most of you that are here will understand that, you know, without the investors and those who will actually invest into the talent and the technology and all of the innovation that actually is present in any ecosystem, nothing can actually move along. So we can have great ideas and great projects, but if nobody's actually going to believe and put money into them, then there's actually no ability for us to grow those companies further. So we started this back in December 2016 to help empower investors, potential investors, those keen on investing, with tools, knowledge, and the network to be able to build between each other either their own VCs, their own angel networks. But this has been an ambition that we've been trying to follow and achieve for the past almost 2 years. And we're happy to say that when we first started, we barely had maybe 40 people or 50 people that were interested. And now we have a network of over 200 investors that are actually keen, have been investing, do it on their own, have even sometimes, in some cases, we have a few of them who have now set up their own VC firms. And we'll get to meet with them later on today as well. We're happy to also note that this is one of the first times we have, I think, an equal amount of people from Bahrain and from outside of Bahrain. So that's been, you know, a great, I guess, achievement and a milestone that we have actually, you know, built our surrounding network to not just be central to Bahrain itself, and further to affirm that when we talk about the region and investing in the region, it's very important to look at us all together because, you know, we all our neighbors, and being able to scale and going to different markets is to be able to have that kind of network. I wanted to thank all of our partners and Beko Capital for helping support this event today. They've been actually one of the first people that supported InvestEd back in December 2016, so we're very happy to have them here again for the 4th edition. And of course, the ongoing support of Startup Bahrain and the Economic Development Board that continue to help put that kind of reaffirmation of the importance of startups within the national economy and ecosystem. Without further ado, I won't take much more time. I wanted to introduce Dr. Simon Galpin, the Managing Director of the Bahrain Economic Development Board, to say a few words. And then I'll come back on stage, give you a quick rundown of today, and we'll start the show. So please enjoy the breakfast while we're talking. And Dr. Simon, please.
Thank you, Arij. Well, firstly, on behalf of my colleagues at the Bahrain Economic Development Board and the Startup Bahrain ecosystem, a very warm welcome to those of you who are visiting from outside of Bahrain. It's great for you to be here. This is really at the beginning of what we call Tech Week, which is a series of events organized by many different parties within the startup ecosystem over the next 9 to 10 days. We're delighted to be supporting this 4th edition of InvestEd. And from our perspective at the EDB, it's really, really exciting to see the momentum that we have in Bahrain in terms of growing the startup ecosystem, growing the fintech cluster and ecosystem here in the kingdom. But one very important component to attracting scale-ups and startups and motivating teams within Bahrain and within Saudi Arabia to start new businesses here, of course, is access to funding. And within the Startup Bahrain initiative, which is an umbrella initiative that involves both the public and private sector, it's really interesting to see how we're managing to fill in different parts of the jigsaw. Starting with working with our partners at Temkeen to introduce minimum viable product funding for very early stage startups. We're looking to improve the regulations so that we can attract crowdfunding organizations to set up and fill in another gap in the ecosystem. We have the Al Wafa Fund of Funds, which has been launched, which is attracting VCs to put their investment professionals here in Bahrain. But also we want to motivate some of our experienced investors, our experienced business leaders, to become much more actively involved in supporting the Bahrain ecosystem. And really, they are the best investors, because if they have the right motivations, if they have the right background, they're really smart investors. They don't just provide capital, they can be the first major customer for startups. They can plug them into their network of business contacts, and they can really help some of these startups to grow very, very quickly. So this is a very significant event for us. Thank you so much for joining us today. I wish you every success, and I look forward to hearing the presentations over the course of the morning. Thank you once again.
Thank you, Dr. Simon. I just wanted to ask the audience, how many of you would classify yourself as an angel investor? Okay, so we have a few. And how many of you would you classify yourself as a corporate venture capital firm? None? Okay. One? Okay. And how many of you are venture capitalists with a VC firm? Okay, so that's the majority. And how many of you are just interested in getting to know more about investing into startups? Interesting. And how many of you are come from, let's say, organizations that invest in various asset classes, not necessarily the venture asset class? Okay, so we have a few. Okay, so we have a good audience. Yeah. Oh, and startups. We have a few startups, I think, right? We have a few startups? Okay, yeah. All right, great. So just to run through the day today, we're going to start with the breakfast with Beko, and then we have another panel discussion right after, and then we'll break. But I would want to also encourage you, for those of you who haven't already signed up in the morning for your lunch tables, so during the lunch is going to be a further networking session whereby you can sign up for any of the VCs that are actually hosting or heading the table. So put your name down and try to spread yourself out. So if you're two from the same organization, try to meet with more people, try to encourage to do that, and hopefully it will be beneficial to continue the discussions. Again, we'll continue the day with another 2 sessions and then end with a break, and then in the evening we have our networking session with not just the investors, but also the startups. So that's also a good opportunity for a lot of you who will be learning a few things today about investing into startups to be able to interact with them later on in the evening. During the day, if you see any of us, we're wearing black jackets, we're all matching today. Please ask us if you need any help. I wanted to also ask all of you to just give a round of applause to the team who've done all of this work to put this together, and they're just over there in the corner. And so we'll start with, I'll introduce Yusuf Hamad, who's a partner with Beko Capital, to do the first session. And we need the clicker. Oh, there's the clicker. Okay, here you go.
Thank you, Arij, for giving me the first session in the morning when everybody's still having breakfast to walk through a lot of numbers. Let me start by introducing myself, Yusuf Hamad, managing partner with a fund called Beko Capital. Beko Capital was set up in 2012. We invest in early stage tech companies in the Middle East. Early stage for us is seed to Series B. Middle East is GCC, Jordan, Lebanon, and Egypt. Our most notable investments have been Careem, Property Finder, and Fetcher. How does this work? Sorry, technical problems from a tech person. Okay, so I think just a quick question. Does anybody know how much dollars per VC, or how much dollars go into VC per capita in the US, apart from Emir? So it's about $300 per capita goes into VC dollars every year in the US. And in the region, we're about $5 to $6. So we still have a big gap to fill in this part of the world. However, about 2 years ago, this was about $2 or so. So we're catching up, not quickly enough. So I'm going to walk you through the progression of deal flow. This is according to closed deals and funded deals that were publicly disclosed. and companies that we've seen ourselves. So it's not going to be 100% accurate because a lot of deals are not disclosed, but it shows the progression. In 2016, we've seen about 90 deals funded. In 2017, 120. In 2018, up to date, there are about 75. So this graph is a bit misleading because it starts from 70, but we're heading in the right direction for 2018. In terms of value, 2016, 860 million dropped to 500 and 120 in 2018. But if you strip out Careem and Souk from these investments from 2016 and 17, you're about 240 million and 350 million. So you're heading upwards. But in 2018, it's still smaller. Our take on that is because a lot of the large funds in the Middle East were fundraising in the first half of 2018, are still continuing to do so. So there's a little bit of catch-up to do. When we split the deals by country, and we're looking at this from 16, 17, and 18, UAE dominates by taking about 50% or more than 50% of the number of deals and more than 90% in terms of deal values. We see Egypt, Lebanon, and Jordan as kind of number 2. And then KSA catching up in 2017, and Egypt doubling. And in 2018, we see the same, both in number of deals and in deal values. Even after stripping out Careem and Souk, the UAE still dominates by about 80%. The interesting part here, we've done some analysis, on an annual basis, we do some analysis to see for UAE originated companies, how much of that dollar actually trickles down into different countries. And even though companies would be domiciled or set up in the UAE, a bulk of the funding would go to different countries around the region. So Careem, for example, out of the 800 or 600 million dollars they've raised so far, about 200 has went into Saudi. Bahrain, we don't have the exact figures, but Egypt and Saudi have taken a lot of the capital. So even though the company is UAE based, it trickles down to the rest of the region. By the way, stop me if you have any questions. I know there's a lot of numbers and everyone is eating, but just stop me if you have any questions. This is deal flow by stage. So there is typically a 2-to-1 or a 3-to-1 ratio, but moving on from seed to A to B and to C. But in terms of value, the Series A has captured most of the value in early stage prior to Series B. Obviously, the C and D take bulk of the large capital, focus on Careem and Souk mostly. This is in 2016. In 2017, we've seen a bit of a shift. There was a few outliers where Series B companies, Stars Play, Arabia has raised a large ticket of $125 million Series B. So there's been a few unique cases. But still, the ratio is pretty much similar. In 2018, we see a much larger number of seed deals, a much lower number of Series A's, but a much higher number of value into the Series A. So when we looked at the average deal value from 2016 to 2018, Series A has gone from $2 million to about $6 million. So obviously, this is the amount of funding and the valuations to follow. When we looked at sectors, so 2016, marketplaces and e-commerce dominated. More than close to 70% of the sectors within tech have been marketplaces and e-commerce. Slowly started diversifying, media, fintech, mobile coming in 2017, and continuing that in 2018. Any questions still? In terms of most active investors, again, this is according to publicly disclosed information. 16, 17, and 18, 500 startups. I don't know if Hassan is here, but 500 startups has been the most active in terms of number of deals. MVP, Wamda, Beko, and Arzan. Although even 2018, a lot of funds are still fundraising. We're still seeing good activity, but slowly and picking up. Sorry, Chris, I didn't have Lumia's numbers.
I'm not telling you.
So that's it. In conclusion, I think what we've seen is we're seeing a rise in number of deals. We're seeing a rise in the value and average deal sizes and valuations. And from the qualitative side, at least what we're seeing at Beko is we're seeing a new breed of entrepreneurs coming up. These are second-time or third-time entrepreneurs, or entrepreneurs that have went through the school of Careem or Property Finder or Souk, that are coming out with a very unique skill set and a much larger ambition. They've been in companies that and seen companies grow from 0 to $1 billion or $2 billion, and are extremely excited and come out and want to build the next big or bigger company. Thank you for your time.
Any questions? Questions, comments?
Yusuf, thank you very much. In terms of investment opportunity here and reaping the benefits of it, everybody's looking to the US and wants to be the next billion listing. If you compare it to the market here, what would be a sweet spot to aim for in terms of value to be listed or value as a trade sale?
So, sorry, can you repeat the last part? Value to?
Investing in entrepreneurs, everybody wants to get up to the $1 billion ticket, have the unicorn. What would be, compared to the market here, a sweet spot for a value where we, as an investor, should be looking for?
Okay, so actually, I could give you a background story about how I joined Beko, and it can answer that very well. So I used to angel invest, and I invested mostly in the US and outside of the region, never invested in the region. And Amir and I met, and the amount of investments that I made as an angel investor in the US, it is extremely difficult to get access to good deals. It is extremely difficult to get access to good deals remotely while you're here. Even as an individual or an angel investor, even as an institution, you will struggle to get into the good funds, and the good funds struggle to get into the good deals. The layers of authority there, it's entrepreneur, VC, GP, then LP. So it's extremely dominated by entrepreneurs picking, the best entrepreneurs pick what the investors that they want. Obviously, I converted into investing in the region, thanks to Amir, but here access to deal is not difficult. There is, like I said, there's $300 per VC, per capita in VC in the US, it's $5 here. Access to deals here is much easier. Second, if the way we think about this part of the world is if you find a strong team combined with, that are well capitalized and are solving a big problem in the Middle East, it is extremely rare that you'll find another team capable, well-funded, solving the same problem. It is almost every new business here is solving or tackling a white space. So in terms of the opportunities here, it depends on what type of institution you are, what type of investor you are, but there are a lot of opportunities that are not tackled yet, and it's easy to access most of the opportunities here. That's one. Second is, I think getting to $1 billion is really interesting, but if you get in a Series A in the US, with an average valuation of 50, 60 million, versus here the average is between 10 to 20. So you don't need to build a $1 billion business. You can get to a $500 million business with the same outcome.
Anyone else?
Thank you.
Great. Thank you, Yusuf.
Thank you, Arij.
Okay, so up next we have Amir. So Amir, you need to tell us your side of the story about how you got Yusuf to invest in the region first, and then you can start your presentation.
You really want me?
Yeah, I really want to know.
So a friend of mine was working at GE Mubadala, and they were going through a bit of restructuring, and so I asked him if he knew anyone interesting that I should meet in the team, and he put me in touch with Yusuf. So I sent, well, he didn't put me in touch, he told me about Yusuf. I went on LinkedIn, and then I sent him a message saying, do you have time for coffee? He replied, and then we sat down and I talked to him about what we're doing at Beko. He was quite reluctant in the beginning. It took me about 8 months of coffees and lunches before he decided to leave GE for a small little startup, which was what we were doing at the time. So, we screenshotted that LinkedIn message, and whenever we were upset with each other, we just send each other that message to make each other comfortable again. Anyway, thanks Arij, and thanks BDB, and it's great to be in Bahrain again. So I get to talk about more interesting things, hopefully. Sorry, Yusuf, but a lot of numbers up front in the morning is quite difficult to digest. So I'm going to just share with you a little bit about how we look at companies in the region and maybe answer Mark's question on what are the typical sizes we see companies being in this part of the world over time. And so I'll just run through. I mean, most of you know, but just for the sake of starting this presentation with insights, is more the VC business model is driven by the power law. And for us at Beko, we take a concentrated investment strategy approach, which means hopefully a lot of our capital is going to be allocated towards the winners in this distribution curve, which are only few, right? And what we target is a third of our investments are going to be winners, and for us we classify anywhere north of 7x, and a third are going to give us our money back, and then a third are going to be zero, right? Most of the time we take early bets, and you'll have losers along the way. But the net outcome is that you should be able to make returns, and significant returns, if you have that kind of distribution. So this maybe would answer Mark's question in that when we look at companies, we kind of have some sort of indicative benchmarks that we look for. Basically, if we just take revenue simply as an indicator, we look at companies that can generate north of $20 million in net revenues and get an enterprise value of 100 million. We think that's a good outcome. And there will be some of those that are coming out of the region over time. A great outcome, we think, is obviously 30, but the real home runs, we think we can generate a handful of $500 million plus companies. Unicorns, I mean, billion-dollar companies in the region are going to be very difficult to get. Kareem is an outlier. We have a couple in our portfolio that could achieve those numbers, but generally across the distribution, 500 million is what we target companies to end up being over time. And so, just to give you an idea, if we look at some cycles of what we've seen over the past 12, 15 years, with Souk obviously being a $650 million company, started in 2005, arguably a bit earlier. Talabat, 170 million, and obviously Kareem now is north of $1 billion, closer even to $2 billion. And these have started in cycles, but it shows you the maturity of the ecosystem, and the time it takes to build value here has drastically diminished. 12 years ago it took Souk 12 years to build that kind of value. To Kareem, it took them 5 years to build their value. Obviously, markets are different, but generally the adoption is much faster today. And so when we model out our return profile, we invest at the first two stages. We're seed investors and early and Series A investors. Occasionally there's a stage called pre-A, late seed, which we invest in as well. And when we look at these stages, we target these kind of returns. Greater than 15x over a 9-year period, because we come in really early. 8 to 12, or 8 to 10x on the A round investments, and B rounds anywhere from 5 to 8x. And it's important for us because as we follow on these companies, we still have to make those assessments to make sure that they're delivering value. Quick look at this slide. Too much information here, but essentially what it's saying is that we invest in 1% of what we see. We try and find those outliers, and so we have to be really selective. And today we're actually at 0.6% in terms of what we see we invest in on an annual basis. So this is sort of how we look at the world of, or how I look at the world. I don't want to speak on behalf of all our team members because we have different viewpoints on this. But it's about de-risking. So every stage of funding, the entrepreneur has to demonstrate that he can de-risk something in his business. So at the seed stage, he has to show that he has the leadership skills to go out and get people to buy in on his idea, join him on the journey or her on the journey. And then he has to be able to take his idea from an idea onto an actual prototype of some kind to show that he can execute, right? And so once he demonstrates that, that gives us some interest as investors that this guy or this person, entrepreneur, has the execution capabilities potentially to build something massive. And we also spend time understanding their ambition and vision because we want really to find these guys who want to change the world, right? And they're, or over time, just to give you some insights, a lot of the entrepreneurs we've seen have kind of relatively low ambitions, and I think it's a lot to do with the fear of failure and the cultural issues that we've had in the region, but that's changing very fast. At the Series A stage, we try and understand if companies can demonstrate that they can take the product to market, they have a business model that works behind this idea, and unit economics that are profitable, or at least going towards that stage. And then B stages, we look for companies that are able to institutionalize some of their parts of the business and get ready to scale over time. And C is more of that, and maybe taking that business model into new markets to show that they can scale even to greater markets. So high-level criteria of how we look at it, and this, it's 80%, maybe even 90% about the team. You know, if we look at over time, we made about 22 investments today, and when we look at the patterns we see amongst most of these founders, is that there's a consistent sort of characteristics that exist amongst them. One of them being their clarity of vision and their real ambition and drive towards solving this problem. They have a real passion for it. They have domain expertise, and they've built a strong team around them with the same attributes. And so when we spend time with these founders, the way we solve this problem, because it's very difficult to assess whether a founder is going to be amazing. There's no formula or checklist you can use, except spending time with them and really understanding if they have if they have the vision and wherewithal to go through the journey, because entrepreneurship is not for everyone. You know, it's a really tough journey. Excuse me. So then we look at transformational. We really are trying to understand how transformational their solution is to what exists today, and we come up with a factor of 10x. That's something that's difficult to measure again, but really it's demonstrated by if it's faster, cheaper, or easier to do. And one example we have is Property Finder. When we invested, at the time, the other alternative solutions that existed were paying for ads on print classifieds, right? Where you have limited inventory of properties that are listed on those print classifieds. It's much more expensive. So they moved it online, and they allowed for a wider range of properties to be listed. Brokers spent less to list their properties, and customers found it so much easier to go and search for property. So that's the type of solutions we try and find that entrepreneurs are solving with technology. And finally, the last two, one of them is basically, again, the addressable market. We try and find companies that are really targeting large markets, anything north of $100 million in size, at least on a local level. And one of the examples we have is a company called BAHRAIN that we invested in, which is targeting health insurance. I mean, let alone in the UAE alone, it's a $2.5 billion market. And if you take the SME segment, which is who they focus on, it's a few $100 million in size. So they can build that significant business just in the UAE alone. So if they can export that model into other markets, they could be, building significant value over the long term. And we look for companies that are capital efficient. I mean, we're a small fund. Our second fund is hopefully $80 million to $100 million fund. So we don't have the we want to find companies that are able to take $1 and extract a ton of value. And if we look at, again, some of our most amazingly performing companies, like Property Finder or Careem or Fetcher, for every $1 they've raised, they've created north of 5x in enterprise value. And that kind of relationship is what we look for when we invest. Finally, we look, technology is a people business. It's very difficult to build moats and competitive advantage. But the way we look at it is when we spend time early in the business, we try and understand what can they do over time to build moats and protect themselves from competition. And some of the concepts that exist in the tech sector is the concept of network effects, which is prevalent in classifieds and marketplaces, where the more listings you have on your platform of properties, the more people will come visit your website. The more people come visit your website, the more listings you get. So that relationship builds a moat and is very difficult to disrupt. Switching costs exist with software companies. Once you onboard a new software in your business, it's very difficult for you to switch into another one. And we look for economies of scale, and eventually what happens is, if you look at Careem today, I don't know if any of you have seen the new branding campaign they've done. It's across the region now. It's a regional campaign. So I think their advantage today is more on the brand side, and that happens as you scale your company. You can start building defensibility just on brand and customer experience. And that's it. So hopefully that covers how we look at the world of startups and when we look our criteria of investing. Happy to answer questions from anybody.
Come on, yeah, okay,
Yeah,
good.
okay.
I was just wondering, also from the earlier session, how are the deals in the region tracked? Is there an entity that tracks them, or is it just word of mouth that goes around?
I mean, there's an entity that's starting to track it called Magnet that's based in Dubai.
Okay. Yeah, but there's no, there's no official entity, or it's a private entity, right?
Yeah, it's a
Okay.
private entity, yeah.
Okay, and most of the information, is it usually accurate that is passed around, or how do you collect it now before Magnet?
How do we collect it? We, just through press releases,
Okay.
and if we meet companies, we get that information.
Okay.
So we start tracking it into our system. That's pretty much the only way. With Magnet, what they do is they reach out to us. So we typically share.
You feed.
Yeah, we typically share some, not everything. It depends on if the founder is open to sharing the details. But yeah, we share enough information.
Okay, so mostly it's from newsfeed that goes around. Yeah. Okay, thank you.
But it's also now become, so just to answer your question, it's become a marketing tool for a lot of these companies. They want to be exposed when they do a deal on these platforms. So now it's a lot more inbound for Magnet than it is outbound. And I think that's going to get more and more prevalent as the ecosystem matures.
Good morning. My name is Anurag, and I'm the CEO of Prepay Nation, a Finch Capital portfolio company. The question I have is, the entrepreneurs you see in the region, are they from the region, or are they, expats who are coming here and starting the businesses?
Great question. So most of them are not from the region. We do have several that are, but I mean the majority are not. But it's typically people who've been here long enough or have family ties to the region to a certain extent where there is comfort, they understand the cultural issues of this region. It's not somebody 1 year into landing in Dubai decides to start it. Yeah.
And second is, are you seeing that these people or these companies are solving the problems which are specific to the region, or these are the companies which are solving the problems for, let's say, Africa or Asia market?
No, so yes, good question. I think of the first fund, our first fund, 16 companies, I would say 70 to 80% were regional problems they're solving. 20 to 30 were global. This batch of companies we invested for in our second fund, I'd say it's 50-50. So 50 global problems, 50 or global application, let's say. But nothing. But most of them are also solving local issues, just because there are a lot of problems we have in the region that we want to solve for.
Thank you.
Welcome.
Hello, this is Shane from Shorog Investments. I'm here. I feel that a lot of the successes here we talk about in the region, like they are successful when they start attracting capital from the U.S. or let's say U.S. investors, because I do believe they do value a lot of the companies from the region higher than what a lot of local investors do. And I personally feel that that's actually a very healthy thing for like U.S. investors, European investors, even Asian investors to start investing in the region. And how can we as fellow investors from the region actually make that or allow that or enable that to happen more frequently? Because like a venture invested by NEA, we know a lot of rumors going around, and some of these big unicorns from the region, they all have a U.S. investors as part of the story, right? And I personally feel that's really healthy, and also that's very good and encourageable. But how can we help them from the portfolio company standpoint to make that happen?
It's a great question. So I can tell you what we're doing. Maybe that'll. So I think it's a lot to do with just educating those markets, going to those markets often enough and showing them these opportunities. So, Yusuf was actually going to go to China and then do a roadshow there. We go to San Francisco a lot. We're part of something called the Co-Fondateur Fellows program, which allows us to go and build relationships with VCs on a global scale. It's just building those bridges, but I think it's also showing more successes. So NEA was an exciting one, and I think that's given some comfort when you in terms of sharing more deal flow to NEA for the region because they've made one investment. And then over time, as their peers start seeing NEA investing, it's just a matter of time and just fostering those relationships. So that's what we're doing. It's much more of a longer term game. I think the other way is to do actually events in those markets. So maybe do an event in San Francisco, bringing the best startups in the region and showcasing them one by one to these VCs, and over time that'll change. I mean, Karim, to be honest with you, has done a lot for us on that front. Okay.
No one? I'm going to ask a question soon, so.
You want to ask?
Actually, I have a question, Amir. I mean, I kind of know the answer, but I don't think a lot of people here do. I want to ask about how you actually started Beko. So, I mean, we talked about how Yusuf joined you guys, but then I want to know how you guys actually came together and why did you do it? I mean, it's a lot of work, right?
Yeah, no, it was tough. I work with my cousin, who's my partner as well, Danny. I don't know if you ever met him, but he's the one with the most energy out of the three of us. He'll light up this room very quickly. Working with family is also pretty tough. We started, so I moved back in 2008 from the UK and ended up working for the government. They had a seed fund that they started in 2008, and crisis hit, right? So I ended up leaving, or at least we had no more money to invest. So I find an ad on a newspaper that BAHRAIN, who's my cousin is one of the co-founders of, are launching a corporate VC. And I had been working in VC at the time for 4 years, and the region was so early that not many people had that much experience. So I was pretty shocked that my cousin didn't get on the phone to call me and tell me that he's doing this. So I just give him a call, and he's 10 years my senior, so we weren't that close growing up. But I call him up, I'm like, Danny, you know I do this for a living, right? And he's like, no. I'm like, okay, well I do, so let's start working together. And then we spent three months working on it. BAHRAIN decided not to launch their corporate VC because their recruitment platform, crisis hit, nobody's recruiting, so they decided to focus on the core business. And then 3 years on, we just, over WhatsApp, what you'll know if you ever meet Danny is he's a very impatient guy. So he exited his holdings in BAHRAIN and a couple of other businesses and spent 6 months going through a life discovery. And he doesn't stop using WhatsApp, so he's WhatsApping me every minute. And then he's like, let's think about working together again. And when we came up with Beko, and it was a long journey. We invested our own money for the first 2 years into 5 companies, got Property Finder, luckily enough, early in the process. And then raised our first fund, and then Yusuf joined us in that process. So it's definitely a long road, and you know, fundraising isn't that easy for VC funds in this part of the world. So Arish has been very supportive on that. So thank you. I don't know if that answers your question.
It does. No one has any questions on that. I have a lot of follow-up questions. I see Chris wants to ask a question again. See, please introduce yourself, because I mean.
Hi, I'm Chris Rogers, and I think I might be the only US VC here. I'm not 100% certain, but back, I wanted to follow up on the, okay. Oh, hey, you are here. Great. But he's Bahraini. On the topic of US investors into startups and the healthy nature that it is, I can't disagree that it can be helpful, because we like to be helpful, and in the companies we've invested in, I think we have been. But, and I would say there's a lot more activity among the local venture community making their way to San Francisco. And I don't think it's just because edibles are legal there. I think it's a broader effort to sort of learn about the ecosystem. But what I do see is sort of an unhealthy focus by the entrepreneurs on getting money. And of course that works to our advantage, but it's a bit sort of like Silicon Valley is the mecca of that. And when I see them come over and spend a month knocking on every door they can knock on, meeting with firms that have no chance of making an investment in them, it's disappointing, and it's quite inefficient. So there's got to be a balance there where you don't just say, you know, go over there and find your way, because most of these big firms, the names that they're targeting, have 20 and 30 associates whose job is to have meetings. And they'll have meetings with anybody, and they'll even have a second meeting. But it just goes into a database. It doesn't turn into investments. So I think there's really a balance there.
Thanks, Chris. But I mean, I wanted to actually follow up on that one. Does anyone want to comment on that?
No.
Any of the other VCs here that send their startups over there?
No, he's right. I mean, we've seen it with our investments. Later stage companies, when we have a gap in the region at the 10+ rounds, so they end up going to those markets. And he's right, you end up spending time with associates that don't necessarily mean you're getting an investment. So there is a delicate, you need a very strong introduction to the top that can help. But apart from that, you may be running around meeting associates the whole time. So.
Okay, so that brings me to my next point. So how do we overcome that? You know, how easy is it to sort of penetrate these networks and be able to contact the top level? Anyone who's been able to do that? The guys, oh. Abdallah, right? Yes. No, yeah, go ahead.
Hello, everyone. My name is Abdallah Yafi, and with my brother who's here, we run BNY Venture Partners. So we're a MENA fund, but we invest globally. And to overcome these challenges and attract actually US and European investors to MENA, what we've done is quite specific actually. We're allowing ourselves today, we're a global fund, so we invest in MENA, but we also invest abroad. And typically we're coming in at the earlier stage in MENA, so seed and late seed. And when you're investing in Europe and the US, we're typically coming in at early growth, so A and B. And you know, by allowing ourselves to invest and you know, by building a thesis around bridging the Middle East and the more mature Western markets such as Europe and the US, what we've really done is we've created a lot of externalities. So we've built a very good network of VCs abroad as well that are looking at our portfolio today in MENA the same way we look at their portfolio in Europe. So by building a brand that's global, and by, you know, building our whole thesis around, you know, bridging our part of the world with Europe and the US, we've allowed our companies to, you know, build global companies, but we've also attracted money from us. So we have, we have at least 3 or 4 companies in our portfolio today that have attracted money from you know, leading VCs in Europe and the US. And I think we'll talk about it a bit later on in more detail, but, you know, I think, you know, what I'm trying to say is by opening our horizons to and allowing ourselves to invest abroad as well, it has helped tremendously our portfolio companies attract money from Europe and the US.
Thanks, Abdallah.
Thank you, Arij. So, Mahmoud from Shuruq Investment. I have 2 points to kind of address what Chris is talking about. So first of all, I think in this region, today we lack growth capital, right? And this is sort of kind of wider problem. And it is upon the ecosystem as well as the capital provider to find a way to address that problem. And once we can have like a healthy growth capital that kind of bring the companies to a level that become attractive to the US or the international ecosystem, we become to have an attractive product that the guys in the US or Silicon Valley look at it as something that's of attractiveness that they want to be part of it, right? Rather than today going there and knocking the doors and trying to sell something that's not necessarily of interest for them. So it is one of the areas to solve it is to create a growth capital in the region. And I think there are a few people who are trying to work on that, but it's still very, very early stage. That's one. And the second point here is, and I think this is we're trying to do at Shuruq, where we partner with international VC firms. So we are trying to partner, or we are in an advanced discussion with the Chinese VC, where we're trying to partner with them and trying to solve the problem of the growth capital, right? Once you are in a partner with a few selected firms who have interest in the region, and they have been sort of kind of following your track record or following your companies as early on, they would be more comfortable to sort of take bets as a follow-on capital on the companies that you have. And I think that is another way to sort of kind of de-risk or put the companies at different footage versus the kind of the approach of going and pushing companies to the Silicon Valley. Personally, I'm coming from the Silicon Valley, so we know how tough it is there for getting good deals. There is, like the investor out there, they will not shy from good deals. They are chasing good deals. Valuation here attractive. So as long as we can give them good deals and attractive valuation, there is no point not to do it.
I have a quick question for
Okay.
okay. Capital, or you guys aren't doing a good enough job of getting the regional capital into your funds for deployment? Because I don't think there's any problem with capital. To Yusuf's point earlier, whatever,
Sorry,
$6 per capita or whatever it was?
Sorry, we need the microphone for the video. Okay, yeah.
Sorry. I think Mahmoud heard my question. So why are you doing such a poor job of teasing the cash out of the deep pockets of people of the region? Why are you going to China? Why are you going to the US to find it?
So I think this is sort of kind of longer discussion. There is different views about the ecosystem here in the region, right? So we know that the region does not lack capital. Capital is available. Capital is chasing deals outside the region in different asset classes, right? I would say it actually created an opportunity that, if you think about the region, it is probably the largest untapped venture capital market. If you sort of observe different markets and how the VC evolve in those markets, what you would observe that typically the market participant or the capital provider in the region, they are the last to believe in their ecosystem. And we have seen this in the East, and it's sort of coming here. It will take time for people who are capital provider at LP level to realize that, okay, this is a region that I want to have exposure to. So it is changing as a mindset, but I think it's going to take time. It is in the early stage of it. Eventually it will happen, but that's a good news for everyone here, because the value of the asset class will increase, and hopefully people have exposure to that.
Can I add to this?
Yeah, sure.
So in our journey of fundraising, we've discovered that this is one of the worst regions in the world to fundraise for venture capital in. So DFIs, so the developmental financial institutions, the global ones, think the GCC have a lot of money, so they don't want to invest in them. So they'd rather look at more developing markets. The Europeans and the Americans think that this is too early of an ecosystem and too small to invest in, so it's not really interesting. And the local investors want to diversify away from their operating entities and their backyard, so they want to invest outside of the region. So you're really stuck or left with very, very few investors that are local and are willing to invest in their own backyard in such a risky asset class. So that's slowly changing now. We're seeing, one of the few government-backed or quasi-government money coming into the region out of Bahrain, coming into this VC asset class. But it's slowly changing, but it's definitely extremely difficult. We kept saying, I think, it's easier to raise a fund if you're probably in Africa or focused on Levant rather than the GCC.
Great. Okay, we have one here, and we'll come back to you.
Hi there. Ooh, very loud. Emma Sinclair from Enterprise Alumni. We're an enterprise software company based out of California. Really interesting listening to everyone today. First of all, I think there's a real competitive edge in the Middle East, and we talked about investing in, taking money from Silicon Valley. We very willingly and happily have taken money in our last round from the region, from BNY, in fact. And I think a point to make, perhaps, if it's difficult to raise venture here, is that sometimes you have to hold up beacons or people that perform well. And so I think making it easy for US-based companies to receive investment and investing in overseas companies could really potentially help the ecosystem, because, of course, what then happens, or so far, fortunately, is happening with us, is we are performing well. And I think in that happening, our investors are keen to introduce us to other investors in the region. So I think it's really important to have a really international focus, because on entrepreneurs, as we all know, should be thinking globally, and therefore you should be taking investment globally. And for us, I consider it a competitive edge that we have insights, contacts, and access to the region, because it's as important for us as anywhere else in the world. So I think it's very important to have an international presence and an international outlook when investing, because you can give confidence to your fellow investors in the region.
Hi, my name is Tariq Hussain. I'm from Gobi Partners. So I think I just wanted to share our perspective from a Chinese VC. I don't think the VC funds in the region are doing a bad job in raising capital, right? When we started fundraising in China in 1999, we received the same skeptical mindset from the local investors, right? When we moved to Southeast Asia in 2010, when we spoke to the Singaporean government, we were like, we want to, raise from you, we want to invest in Singapore, and they came to us and said, look, we want to talk to you about investing in China, right? So I think that's a mindset issue. I think that's going to change. You're going to always get skeptical local investors from the get-go. I think once you see examples in the region, it's going to open up, right? And then just to address, this obsession with Middle Eastern entrepreneurs with the value, right? I think everybody looks in this region looks to the West, right? But there's this whole ecosystem in China that is being played out. It's extremely developed, and nobody looks at China. So I think, as an entrepreneur, I would advise the guys, just don't look at the valley, look in China as well. Right? There's a lot of capital coming out of China. When we invest in China, it's so competitive. The first meeting that when we have, we need to have a term sheet prepared. Right? It's so competitive because if you say no, if you take time, they're just going to jump to the next guy. So it's the valley is amazing, but China is also pretty something. Thank you.
Can I just add a couple of points here?
Yeah, please.
So I agree on China. I think it's going to be an interesting route for a lot of these startups, at least both from an acquisition perspective and from an investment perspective. What we see, just to add, is that families here, they're going through generational changes, and the younger people who never had the keys to the vault, let's say, of those families are now getting them. And over time, what happens is as soon as one or two of these guys or girls invest in this asset class, it just creates this wave. So we have some amazing LPs in our second fund, typically young executives or young people from large families, and they're bringing their counterparts who are also younger people from younger families. And I think the generational gap is also a problem where let's say, older people don't understand technology so much. They prefer real estate, and so the younger ones now are much more accepting to that asset class.
Okay, hello everybody. My name's Patrick Lord. I'm from Truffle Capital. We're a European VC fund. And one of our investment theses is to invest in deep tech, technology that creates a barrier to entry. So what do you see in the landscape here in terms of startups that are using deep technology, for example, artificial intelligence, blockchain, etc., and also in terms of technology transfer from research?
So from our portfolio today, I would say that it's very limited, right? A lot of these companies are solving white spaces, so what exists for years in the US or developed markets don't exactly exist here. Like even as simple as a job site or a property classifieds, those are only like less than 10 years old versus the US, which is 20, if that makes sense. So I think these are the first sort of stages of development. But what we're seeing with, let's say, the likes of Kareem, we invested in a company called Swivel. They are now disrupting regional problems, but using technology, deeper technology, to take an edge off. So, for example, Swivel is a on-demand bus platform in Egypt, and they're using the data that they're getting to do dynamic routing and other things that gives them much more of an advantage to anyone who tries to enter that market, especially because Egypt is such a complicated market as well. So we're not there at the point of innovation yet, but we're getting there.
Hello, this is Numan from 212. I mean, hi Amir. I just want to basically continue to what Amir was saying. I mean, ecosystem is very young actually here in the region. Like oldest VC is what, about 10 or 8 years old. So it's like a supply and demand problem here. Because a lot of VCs are new, and so as the entrepreneurs, so they basically choose to come businesses or business models that they can find the money. As a result, the deep tech and all the other stuff is coming a little bit late actually in this sector. So I think it will take some time, and we are seeing some companies, but it will take some time.
I just wanted to comment something quick on this one. So I wonder, because I also come from the US Silicon Valley, and my peers in the US, they always tell me, Shin, you guys don't have any hardcore tech. Like you guys don't really have a lot of like machine learning, robotics, AI, all that, let's say sexy stuff that US people normally say. And then my response to them is, we don't always need all those like cool and fancy stuff for the region. Just because, I mean, the reason can be a lot of variety of factors. We don't have talent like the US, like Caltech, MIT. We just don't have that pool. But also at the same time, the market, the region does not always need like a hardcore semiconductor related stuff. I used to invest in the semis around the globe in India, in China, and the US. Like all those like super leading edge technologies are great for the US, but I'm pretty confident that they are not applicable for the region. So we can totally invest in good companies that disrupt the business model like Amir and Yusuf is saying, and we don't always need to focus on those hardcore tech.
Did I see a hand somewhere? No? I actually wanted to make a point on some of the points that were being made. Do you want to say something first? Oh.
Do you need me to stand up? Or?
No, go ahead. Please enjoy the breakfast. Yeah, no, sir. I wanted to, I mean, I think Emma was mentioning something about, having an international presence. And then, a lot of people were discussing about, how the money and then the focus will come back into the region. But then I'm going to sort of play devil's advocate here. But a lot of people say that, when you're actually building your business, you need to stay focused. You need to stay focused on what you're doing. And then, I mean, I don't know if I understood your point correctly, but, how are you, so getting that kind of investment from outside, how does that sort of add value to you if you're just based in Silicon Valley and, BNY? Sorry, I'm going to get you to speak into the mic, yeah. Okay, all right.
I think, clearly there are some people that work best regionally and just serve a region. But I'm thinking but I think for our case and in the case of much of the enterprise software market, you're global from day one. It doesn't really matter where we're based. Our customers are all over the world. And, I remember when we were looking at our first couple of customers in the Middle East, very early on, there were questions, you've got tons of customers in the US, tons of customers in Europe. What are you going to the Middle East for? Build your stronghold. But we wanted competitive advantage, we wanted to take the Middle East market, and we wanted to be first in. So I think my point is that it's nothing to do with focus necessarily. If you are a business, you need to act locally, but think globally, and therefore limiting yourself, or certainly speaking for myself geographically, would have been short-sighted. And so for me, being part of an ecosystem in the Middle East is extremely important to my business.
So I mean, if I can sort of add to that, so you're saying that, as a business, being able to have an international-based investor helps you sort of scale globally. And how long after you started did you start looking at investments outside? So how long have you been in business?
So we've been trading our core product for about 2.5 years. We've been in business for 4. But from day one, we had investors in different regions. We had both UK and investors from the first round that we did. This round, we've got Australia, US, UK, and as I mentioned, Middle East. And I think, for me, probably for most entrepreneurs in the room, finding the kind of money that believes in you, that can support your journey, and that understands who you are and what the DNA of your business is extremely important. And just like anything in life, relationships don't have borders. So you can find people that you resonate with and that resonate with you all over the world. We're very fortunate that happened for us, in a variety of different geographies. So I completely understand the need to build a domestic ecosystem, hugely important. But I hope that what some Middle Eastern investors, I hope, will get from investing in us is that we also give back. We spend time going to talk to the ecosystems where our investors are. We mix with other portfolio companies, we create introductions. So I just think that it's really important to act globally at all times, because the world is a global place. Transactions are not limited by global borders. And to the point about money, as much as people head to Silicon Valley and everything else, I'm considered unorthodox, which is I don't necessarily think it's a be-all and end-all. I don't in any way think that I don't want money from that region, but I think you have to find the people that fit exactly who you are, and one size does not fit all. So, how glorious to create a lot of different types of opportunities, types of investors, and to be able to have the choice, which I think is important.
Great, thank you. Does anyone have any questions based on that? Or shall I continue? I have a lot. No? My other point is, I think it was someone who, I don't remember who, was mentioning, they were investing in Silicon Valley. I don't know if it was Mahmoud or Shane, and they've come to the region. How many people in the room made their first investment out into the Silicon Valley? Okay, so we have Mahmoud and, okay, all of you guys. So, all right, so why was that your first investment? I mean, and I think maybe I'm going to ask Farid. I'm going to put you on the spot. And why didn't, so Farid's from Bahrain, right? So why wasn't your first investment here?
Can I have? Yeah. Hello, Farid. I have created an angel investment company, which our idea was to invest into startups in Bahrain initially. That was the idea. We created a fund to invest into startups, but when we did our research and we found out that the startups in Bahrain lack certain qualities and lack deep technology. So we decided that in order to help those startups and help ourselves, we need to move to Silicon Valley and look beyond the borders and create alliance with other networks there and invest into Silicon Valley startups there. So, and in order to invest into those startups and bring them back to the region, for them to benefit from the knowledge and technology they have, we have invested into 5 startups there. We start in pre-seed companies, and the verticals are in AI, blockchain, marketplace, health tech, food tech. And then now we see the reverse now. Those companies which we have invested in, they are now interested to come to the region, looking for further funding. And this is an interesting thing, which I think the discussion is made here. The capital is capital in the region. It's available, but some of the VCs don't believe in the startups themselves, and some are the startups lack deep technology, and they are not going to scale up in the long term. But it's changing. What we see is in Dubai, actually, there are a lot of things happening there, but in Bahrain, this is what we had discussed with my colleagues here. There are a lot of funds here, but we don't see anything happening in terms of scaling up of businesses. Either they are not solving big problems, or they are lacking experience and knowledge.
Okay. Thanks, Farid. Does anyone want to comment on that? How many people agree with that statement? I mean, how can we resolve that? Okay, we have Hassan.
Yeah, I don't agree with that statement.
Hassan, just introduce yourself. Okay.
Hi, Hassan Haider, partner at 500 Startups, Bahraini as well. So There actually is a lot of talent here in Bahrain, and I've been in the ecosystem since about 2007 with my own startup. Started Tenmu in 2010. So I've seen a lot happen, and there's a lot more happening. What was really cool for me is during the coming week with the Tech Week and everything that's happening in Bahrain, there's more startups, more accelerator programs, more incubators, more companies that are here than I even know. And for me, that's great, because Bahrain's a tiny market, and I used to know everyone. And so I think there's actually a lot of activity happening here. You've got Flat Six Labs have launched recently. Brink have an accelerator program. All of these startups are still pretty early. I think there's a lot of opportunity and a lot of talent here to invest in, and we've already done, I think, 3 or 4 investments in Bahrain as 500. So, yeah, I think there's opportunity everywhere. You just have to choose and watch the market pretty closely.
Hassan, how did you, I mean, you're a US-based VC, right? So how did you get, your partners to, actually trust Bahrain or the region?
I mean, it wasn't a lot of convincing. The founders themselves are pretty good. So once we found good founders who were motivated and were execution focused and put them in front of anyone, like they were able to convince them that the investment was good. So that's pretty much it. Look for the right founders that have a bias towards execution, and that's enough to convince anyone to invest in any sort of market. I think that's...
So there is talent. We just have to find it.
Yeah, it's like in any market. It's not always at the surface.
At the surface, yeah. We have a question here.
Assalamu alaikum. Hello everyone. My name is Qais Al Isa, founding partner Vision Ventures, Saudi Arabia. It's not a question, it's actually a comment and a follow-up. I think the region is really developing much faster than I thought, at least. Going back a couple of years or 3 years when we started investing as a VC, we've seen a lot change in the region, not only in Bahrain, but also in Saudi Arabia, Dubai, Kuwait, across the region. I think there are many things, of course, Egypt, Jordan. It's very exciting, I think, for us. And I think this will draw a lot more capital. So that goes back to what Amir and Yusuf were saying early on. Capital will come when we also show success. When we show funds that are returning good value to investors, and when we show startups that are able to really grow fast and attract probably regional or international investors for exits. IPOs, stuff like that. Definitely the current slowdown in the economy is shaking up many things. Businesses are facing difficulties, and this is opening up also new opportunities for startups. And it's again making things very exciting, really, at least from our point of view. So I think the region is really moving forward towards a lot more maturity. And I think this is very exciting, at least from our point of view. We're seeing a lot more startups that are more attractive to us. In Saudi Arabia 3 years back, it was barely hard. It was very hard, at least for us, to see a startup that's very interesting for investment. Today, we have a lot more in the pipeline that we are investing in, and each one of them has something really unique to offer. Not only technology, but also great founders and great team in the startups. So I think it's really developing very, very well. Thank you.
I mean, Qais, I just wanted to ask you. So you're saying, it's developing, and we want to get to IPOs, and we want to develop that way. So we hear about Kareem, right? And we know about Souq.com. So and again, I'm going to, play devil's advocate here. So how long am I supposed to wait? If I'm an investor, I'm interested, I can put my money into real estate, and, I know it's there, and I can touch it, and, it's there. How long do I have to be patient enough? And, what if it goes wrong? So I just forget that founder, or, what would you do?
As an investor, you're speaking as an LP?
As someone who, no, not even an LP. Like, I want to become an angel investor. So I'm hearing all about this. I'm hearing that there is talent, there is opportunity, the money is here. I just have to find it. How long do I have to wait before I can actually reap benefits? Because I put my money in real estate. Why should I put in?
I think this is again part of the the change in the way also capital thinks now in the region. So as you said, everybody thinks and used to think of real estate as being safe, as being very in real estate, at least in Saudi Arabia, in 10 years you return your capital and you still have your asset there that can generate revenues and create capital growth. But it's not anymore. That's not the case today, and that's what I meant with that. Things are changing in the region, and we're also raising capital. So when we go to people and we talk to them, a lot of them are also used to the real estate mentality of investment, that it is guaranteed, capital is coming, definitely, and all of that. But now it's not anymore. So now they are actually looking for alternatives. It's just that they need a little bit more education, let's say, and what VC means, what is this investment class that's coming up in the region that did not exist probably like 5 years back or so. And I'm seeing a lot of them, of course, are struggling, trying to understand, but also some are accepting and then are starting to invest, probably a little bit here and there, but then they are actually testing the waters and seeing how things go. And again, as Amir said, the relatively young mentality coming into the region and gaining capital access from their families is also pushing that forward faster.
Thank you. I'm going to ask a follow-up and then I'll come to you guys. I might be answering your question, I'm not sure. But okay, so you're convincing, you're raising money, and we have a lot of VCs here that are probably raising or have raised funds. So when you say that you're convincing them, right, this is an alternative asset class, and then, why not invest into startups? But, it's not guaranteed, right? So how do you explain when you take money from these people who've never invested into startups and convince them, and then, what if it just goes away? It just burns. Like, how can you then then he'll come and tell you, well, I should have put it into that house, at least I could touch it. Right now, this has gone into thin air. How? Walid, you want to answer that?
Yeah. I can run you my pitch if you want. My name is Walid Mansour. I'm with Middle East Venture Partners, I'm EVP. So to date, we raised, I think, around confirmed commitments, around $360 million in our 5 funds to date. And on top of that, we raised, I think, around $100 million of co-investments, all in the venture capital industry, tech industry, GCC, Levant, North Africa, Turkey. I think it's a great number. I think I did not expect to reach that scale when we started 8 years ago. So there is capital. Our pitch is very defined. We think, our belief is that venture capital is a very local industry. So we know how to make money here. We do not know how to make money in other parts of the world, 1. 2, we believe that a VC is not for everybody. As an investor, you either want exposure to this industry or you don't. If you want to analyze returns, actually you'll see that VC returns globally are very volatile. Only top percentile funds globally make all the returns. Second tier, third tier actually probably not even return their capital. By the way, I got this data from Mubadala. I mean, there's very granular data on how US VC funds do perform. So that's the second point. The third point, it's a very long patience capital cycle. So to your point, I think you should expect 10 years, right? But if you are committing to that journey with the mindset of putting money and then waiting for it to triple over time, obviously you're going to have cash flow in and cash flow out because the funds recycle. I think probably you should have maybe another agenda while you join this journey. This agenda could be you're interested in the sector, you would like to have co-investments, you have specific knowledge or exposure to a wave of technology that is disrupting your own core So you spoke about retail or real estate. I think you cannot disregard what e-commerce did to retail or what digital banking will do or fintech will do to banking. So I think you should really have another agenda rather than just pure financial returns. Three, you have to know the big element today that we're all facing with, in order to scale VC's governance. We can spend a lot of time on that, what that means. I think governance is the most important factor in scaling any platform. And this actually means a lot of things internally, letting go of certain things internally. Rearranging your processes, your investment thesis, your checks and balances, etc., etc. Four, don't do VC or tech on your own. Be part of a portfolio that's safer. Obviously, a portfolio approach is better. A portfolio approach will give you synergies, will give you knowledge, and will give you access to more opportunities. For the VC, the portfolio is good because that becomes a source of proprietary deal flow. I think we have more than 2,000 people who work in our portfolio in the Middle East, so we get deals that never go to the market because eventually this is ours. I don't believe in cross-border investing personally. This probably will make some enemies in here tonight. I mean, they're all friends, but I love you guys. The reason is, it's just where I think that I think that VC is very local by design. So it's very important to look at that industry as being a hyper-local industry because of the whole cycle of identifying trends, helping entrepreneurs, investing, bringing local LPs to the machine. So it's crucial that we look at it at least from a very hyper-local perspective. I think the returns of local VCs will be completely different than the returns of Silicon Valley, China, India. I think there's a lot of valuation hype, and eventually it will come up crashing at some point. And it's in every technology cycle, the early technologies get the great valuations, but 3-4 years down the line, when technologies become available to everybody, the next third, fourth, fifth company that raised within the same tech sector becomes more efficient, and therefore those who entered early will, their returns, company returns will adjust. We're just not seeing it here today, but it will happen. It's probably starting to happen. And my final point is on returns, to your point. If you're willing to wait for 10 years, if you have another agenda, if you pick your platform, if you're comfortable with governance, if you look at synergies, etc., I think today is the right time to invest, because when you compare the Arab world or the region to any other geography around the world, the business opportunity is very appealing. Valuations are cheap, markets are big, and the offline-online integration is happening. We have great talent that's now adopting technologies to that. So I think from a valuation perspective, just to compare that, we're maybe, 20% of what's happening in India, 15%, 10%. So super, super lucrative. I think you'll make money if you invest today. We'll talk in 5 years.
I hope so, Walid, for our sake. Okay, Alex, and then we have Ali also has a question.
So less of a question, it's more of a think piece. My name is Dr. Alex Suchi von Weissenfeld, and I'm with CNS, a US-based management and legal consultancy firm. Raising capital is one thing, and gaining access to capital, but the question is also, what do you do once you have it? It's a bit like having the dream car in your driveway and then not having enough roads to drive it on properly. I mean, we've all joked about why would people buy a Lamborghini in this country, but they do. So what we need to do is figure out what people do with the capital that has been raised. And this is often a question that we find in our line of work, where startups form a company and then they need to expand and grow, and then they don't find the necessary infrastructure in their own country to make this happen. In the US, for instance, you create a corporation, you add a couple of extra shares, non-voting shares, everybody has their receipts for investments, everyone's happy. It doesn't work that way in a lot of countries here in the GCC, and therefore that we find or have found in the past that this is another hurdle that needs to be addressed, because investors hate nothing more than insecurity. And the moment they ask you, okay, how are we going to do this? Let's sit down, here's my money, how are we going to restructure the company? And you get, that's a big problem. And I know that the BDBs had this discussion before as well. So I think it needs to be also addressed how institutions like the BDB and other government support facilities, and maybe even angel investors and groups, almost like a lobby, can or should use their collective interest and the power of their collective interest to try to effect some change when it comes to a legal framework that is necessary to accommodate that, which can also then include the security of the investors or certain supervision, but also of the entrepreneurs, because in either case, both parties want to create something that's sustainable, and they want to create returns for their investors, and that should be made easier. Easy access to money is one thing, but it also needs to be discussed as what do you do once you have it, and how it is then being introduced into the company in a matter that secures things down the road. Because if you don't build a proper foundation, no house can stand, and the same goes for a company in either case of either stage of the formation, specifically the growth rate.
Great, thank you. I think we have Ali and then Abdullah.
Hello, everybody. Ali Abu Saud, Hala Venture, Saudi Arabia. I just have a comment on about the questions raised by Arij. Actually, when it comes to the venture capital overall, it's not, again, for everybody. I do believe in that. And I do believe that also venture capitalists are highly driven by passion. So you cannot simply go to someone who's been real estate investors all through his life, and you just convince him to just pitch or ditch money into a VC fund, because he will never get, let's say, the kind of risk, or he won't be even able to sleep without even touching his own asset, you know. So what I do believe in, that it's very important that you make it very clear for whomever you are picking to, the kind of risk, and at the same time you have to look for someone who's into, let's say, in the business overall, and they want to diversify their, let's say, risk, their business. We've seen lots of what's going on in the region in the past few years, and I believe that so many local companies right now, they're trying to diversify their risk, their businesses, and they're trying to capture maybe more opportunities, or looking for other, let's say, either vertical or horizontal integration with their businesses. So therefore, maybe in this approach, it will be much more, let's say, the best way to pitch for other investors. Thank you very much.
Yes. I want to add something to what Walid said, which I think is true about the top percentile VCs generating all of the most, or if not all of the returns. One thing we've seen is we work with a lot of family offices and individual investors ourselves, investors that don't do a venture for a living but are across asset classes and have a portfolio of investments across asset classes. And what we've realized is, in order to make money doing venture, you need to be either doing it full time, or you need to be doing it alongside the top percentile VC funds. And so it's very, very difficult to generate returns in venture capital. So you might as well, and at least two or three family offices we work with tried to do it themselves for many years, and then realized that it wasn't working, because you can be an amazing investor, and I believe all venture investors are probably very smart investors and know what they're doing, but you need the access. That access only belongs to the top percentile funds. So my recommendation to someone that's looking to go into venture and diversify away from the real estate and the private equity and the more traditional asset classes is team up with a VC fund that you trust, that you believe in, and you can partner in and maybe work alongside to start doing your own deals.
Thank you. Oh, and then Ray. Okay. Just in case you guys didn't notice, they're twins.
Hello. Hi, everybody. Rais, Yafi, BNY. I used to go back to your question about venture and whether this is a valid asset class. So if you look at the US, for example, 40% of companies in terms of number are venture-backed, of public companies in the US are venture-backed. I think 40% of job creation is also venture-backed, and maybe a bit less than 60% of total market cap is also venture-backed. So that, I think, says a lot about venture and whether this is a valid asset class to invest in. So clearly there's a lot of value creation in venture. The other point I wanted to make is, and to go back to Walid's point about being a local VC and not believing in investing outside, although I love Walid and MEVP, I think that as an investor you have to be global, and I think that but you cannot, and in line with Abdullah's point, you cannot be global but sitting in the region, because and that's a tricky point about investing globally. If you wait for the deals to come, then you'll get the second and third tier deals. So the good founders will never, the good founders in Europe, the good founders in Silicon Valley, like Emma for instance, will never come to the region to raise money. You have to find them. And how do you find them? You basically build a network that's global. You build a network that you trust of co-investors, and then you add value to the portfolio. And when you add value to your companies, these founders that you're working with will recommend you to other founders, and this is how it works. It's a network of founders, top founders, network with top founders, and eventually once you're supporting one, adding value to one, then you start building a name, and then you can get the access. And that's how we believe you build your global network as a VC here in the region.
Great, thank you. Does anyone have any more comments? Or yeah, we have Khalid.
Hi, I mean, just to add to...
Sorry, Khalid, if you can introduce yourself.
Yes, I'm Khalid Telhouni from Managing Partner at Wanda Capital. Just to kind of as a midway point between what the Yafis are talking about and what MEVP or what Walid was talking about as well, about the nature of venture being local versus global. I think both points of view tend to have a lot of merits to them, I think. I think there's opportunity in going global, but there's a lot to be said about having a local dimension as well. And it's something that we've been thinking a lot about, like how do you kind of bridge both? I think on the local part, I think there's a lot to be said about knowing local context within the venture capital market. This is critical to understanding the nature of market failure within these economies that you operate in, that you are betting on entrepreneurs who are basically plugging those systemic failures or market failures in the economy, and that's effectively the underlying driver of it. But there is opportunity around looking at investments outside, and I think the way we've approached it is really to say, how do you build networks in markets that are adjacent to your core market in MENA? So we've been very successful investing in Turkey, for example, particularly when there's a tie back to MENA. So thinking about how do we drive local knowledge into MENA. More recently, we've expanded a bit more to East Africa, because we also see that there's a lot of opportunity in these underserved markets that looks similar to what's going on in MENA to some degree. So it's about, I think, building out that network slowly over time. The key driver of returns in venture is access to the right investment opportunities. And if you find a way to do that on a global basis, very tricky, but then you're able to do it. That's all. I think the critical part of this game is access.
Thank you, Khalid. I mean, I think if I want to sort of wind down the discussion in general, and coming from when Amir was presenting, and then the points that Yusuf raised, and then thank you for everyone else who participated. I think what we can definitely say that you need to be patient when we're looking at this asset class. And sometimes you might think global, sometimes you might think local. It doesn't, I mean, there's no right or wrong way. And I don't think, I mean, unless anybody in here is an actual fortune teller and can tell me what's going to happen in about 10 years, I don't know if we can actually say there's a right or wrong way. But I think what I would say if I was going to invest into this asset class is what actually works for me and what I'm comfortable with and what I can understand and what I can, be able to digest as an investor. So if I want to be able to have access to global, then maybe I should partner with people that have that kind of thinking. If I believe that, it's more local, then I should invest in someone like Walid who thinks along the same sides, because I think, one key thing that I'm maybe, and, the VCs in the room can tell me this, is that, the partnership, and we talk about, it is a partnership. That's the key of, the success and then the growth of that kind of ability to make the underlying companies succeed. So if you guys are not on the same wavelength and you're investing in me as a startup, then that's going to be a problem for me, I think, in the future. If, each person's arguing about, which direction and where we're going. And I know some of you are still in early stages, or you've just set up your VCs in the region. And I think that's, a key point that I keep hearing is that, each one of the groups here all agree on, the direction that they're looking at and what they want to invest in. And the minute that there is a disagreement, then, we have a problem. And then we can see that even the top tier funds that have been in the news recently have parted and separated their ways. And then that causes an issue, right, later on with your underlying portfolio companies, because they're the ones who are going to suffer when the top partners are, not on the same wavelength. And so there is opportunity here in the region. You need to find the right people that have the same thinking with you. You need to decide when you're assessing the investment what works for you. And there's no right formula. So I'm sure each person here does it, in a different way. But I think you need to be able to agree on what you, amongst yourselves, is the right way. And then, we'll see how the region develops. And what you said, Walid, 10 years? Yeah, 10 years? Okay, so hopefully in 10 years we'll have this conversation again. And, we'll have more of these, success stories to come up. So before I ask you guys just to stand up and stretch, and I'm going to get the Yafi brothers on stage for the next session. But if anyone has any final comments, I want to thank Yusuf and Amir, and then the rest of you for engaging in this first discussion. No? Thank you. So it's time to stretch, and then if I can have Abdullah and Ghaith come on stage. Not leave the room, just stretch, yeah. All right. If I could just ask the people at the back to make your way and have a seat, we'll start. Okay, great. So I know that you guys just spoke during the session, but I don't know if everybody knows you. I know you have some of your friends here in the audience, but if you can introduce yourself and tell us a little bit more about, actually, how you, why are you seated in this room? Actually, why did we have you over?
All right. Thank you, Reach. Lovely to be here in the cold Bahraini weather. Okay, so Abdullah and my brother Reis, we run, as I said earlier, we run BNY Venture Partners. We're a VC fund based out of Beirut that by now you all know invests globally. We have a big focus on the Middle East, but we built the whole fund thesis around bridging our part of the world, and that's MENA, with more mature Western markets such as Europe and the US. So what we do in a nutshell is we come in, invest in the early stages, so seed and A's when we invest in the Middle East, and we'll help our companies become investable to part of our co-investors outside the region and become global companies. But we're also investing in very, very successful early growth companies in Europe and the US. And we're typically that partner that can open doors for those companies in the Middle East. So Emma here is one of the founders we work closely with, and typical example of what we do, investing in a company that's not coming to the Middle East to raise money, investing in a company that's already very successful in its core market, that, in rounds that are typically oversubscribed as well, and alongside, highly qualified investors from our network that we trust. And, these guys typically make room for us because they think we can, add value to the company and help. We help with a number of things. We help with, access to markets. We help with business development. We help with go-to-market. We help with product. Depending on the stage of the company, it varies a lot. Prior to that, maybe I'll give you just a quick intro of who Reis and I are. We're both actually, former founders. If you actually backtrack a little bit, we both have our share of experience in the corporate worlds. I used to be in consulting, essentially building products for a computer science corporation and then Accenture in Paris for about 6 years at the time. My brother Reis worked in banking, investment banking, working for Société Générale and then Houlihan Lokey, doing advisory work, M&A and financial restructuring. And I did an MBA in 2008 at INSEAD. And at the time, got very exposed to entrepreneurship, spent some time in Silicon Valley, but also worked for my end of year project thesis on our family business. And the family business was non-tech. It's a business that my father had started in the early 90s with his cousins. A business you might be familiar with, sightseeing bus tours, actually called Big Bus Tours. A business that, as I said, my father started in the early 90s in Paris, essentially doing hop-on, hop-off bus tours around, some of the largest cities and that attract the large base of tourists around the world. And when I did my thesis at INSEAD on Big Bus, we were at the time in 3 cities, and we were run as a very good, profitable but small business. And when I graduated from INSEAD, I convinced my brother Reis to actually quit banking, and we teamed up on this journey. And since we essentially did 2 things, we joined our family business and helped the business scale, and went from 3 cities at the time to 17 cities in about 5 years. You want me to talk about that? Yeah. Go ahead.
I want to hear Reis' side of the story.
No, but so just to add to what Abdullah was saying earlier, on the fund side, before we go into our entrepreneurship journey on the fund side, and that's important to mention, when we're investing in the region, we're usually leading our deals or co-leading. So we like to work with everyone. But when we're investing outside of the region, we are actually very rarely in the lead. And I think it's important because we do less due diligence. We're faster moving because of the nature of venture outside. It's much faster moving than the region. So we usually piggyback on a lot of the work that the lead investors we trust do. So then to continue on the story of Big Buzz. So through Abdullah, when Abdullah came back from Silicon Valley, what he was doing his MBA, I was working in banking. I was working, 100-hour weeks doing M&A, and so it wasn't very difficult for him to convince me to actually quit the corporate world. But before quitting banking for maybe the last year and a half, we started getting involved with the family business by taking a board seat. And the business was at that time in 3 cities, very profitable, but a small size operation, relatively small size. It was like a $10 million revenue business in 3 cities around the world. So Abdullah and I decided, it's time to take this business to the next level. We thought that we had something that's capable of scaling, that's capable of creating a lot of value. So we went to our family and convinced them that it was time to actually put a plan together and go after and build a global leader. So the first thing we did is we approached. We were based in Paris. We approached the English company in London, Big Bus Tours, and ended up merging our business with them. So we did a merger, which took us from 3 cities to 6 cities, which I was very involved in, given my background in M&A. And then we put a 5-year plan and to actually scale the business and build the global leader. And then so we ended up going from 6 cities to 18 cities in 5 years. Went from 10 million to around 160 million in revenue. And in 2014, decided to exit the business. So we sold 80% of the business to a private equity group in the UK called Exponent. And that was a big outcome, for us, for the family, for the shareholders. And it was an amazing experience for us because Maybe what I can add, because people might be asking, so where's the tech in all of this? And the tech experience came via a couple of routes. One of them was the Big Bus journey, because at the time when Ice and I joined, we were doing 100% of our sales as street sales. So we came in and we thought, there was an opportunity to technologize the business as well. And today, the company sells around 35% of their total sales online. So we built the whole, we productized the business, we technologized, we built the online channels to sell as well. And obviously with that comes everything else, including marketing and SEO and online brand presence. But in parallel to that, we're also involved in a couple of tech startups. So we're the founders of a company that operates out of Lebanon today called Tribe. Tribe is a software for retail business that's today the leader in Lebanon. And company that we started 2011. I myself was running for 3 years, and we raised a total of $5.5 million over the last 4 years, and we're very happy to announce actually a round that we just closed for another 2.1 million to take the business to Saudi. So we all of this to say is before becoming investors, I think we have a good share of experience as operators ourselves, having scaled our family businesses and exited as well, but also built a couple of tech businesses. One of them raised a lot of money for, not too much, but a good amount of money for, and that's today one of the leading software for retail business.
Great. Thank you, Abdullah and Ghaith. But I just want to know a little bit more about, so you graduated, you both did your careers, consulting, banking, and then you helped the family business, and then you exited. But then how did you sort of start BNY, and why, and how did you actually convince the people around you that this is the right way? So you both had secure jobs, then you went into the family business, and now you're going to go out and venture. And maybe tell us, what does the BNY stand for as well?
Yeah, sure. So actually, having moved from the corporate world to entrepreneurship, I think was probably the best decision we've made. building companies, getting involved with founders, working with people was something that's extremely enriching. Throughout our journey, through our passion, I think, for entrepreneurship, we set up an angel vehicle called Y Ventures, which is basically our money, our own money, Abdullah and I, and started doing some small investments in tech startups. We did around 10 investments. That's early 2013. But what we've realized very, very quickly is that being an angel in the region is extremely tricky, because when you're investing pre-seed, you're investing very early. Those companies come back to you 12 months later and like, well, where's the next check? And we didn't have the ability to write that next check because, we didn't have a fund that's deep-pocketed enough. So we quickly realized that these companies were progressing very well, but they needed follow-on capital. At the same time, we were luckily, going through the exit of our family business. So when we exited the business and got some liquidity back, we decided, how about we actually seed our fund and build a VC fund that can not only follow on in our angel portfolio, but also, back other amazing businesses and founders in the region and abroad. So this is how BNY was born. So Abdullah and I went on this journey and we weren't too aggressive in fundraising. We went to our close network because we were first-time managers and we didn't have the track record yet as investors. We had good experience as founders. So we went to our very close network, and during that journey met our third business partner, which is a great guy called Rami Jisr, who we ended up partnering with. And this is how BNY was born. So which is Rami's company called Broadgate Advisor. Rami used to head Audi Investment Bank. So he was the CEO of Audi Investment Bank, or the biggest bank in Lebanon, and left Audi a few years before we started BNY to set up his own shop. And so we teamed up. Rami brought different things to the table. He brought local know-how, local network, very, very good knowledge of the region. We had, operating experience, also a network outside, etc. So together, we thought we can build a really solid foundation for a VC fund, and launch BNY. And that's how it all started. What maybe I can add, what happened is, with having set up Y Ventures and starting to do some angel investing in the region, as I said, we did about 10 investments. We're writing small checks from 20K to 100K max, and then with that, and at the time, you think in 2013, Lebanon, very few investors, very few VCs were out there. I think even like in the region, there were about 10 venture capital investors, when you have around 200 today. So you can see, how this, the segment has grown. But so, we had written that first check, but, there was nobody to follow, right? The different stages weren't developed yet. And which pushed us, actually, is one of the reasons why, because we're spending so much time trying to fundraise for our portfolio companies. Which got us to stop and think at some point, hey, let's just raise a fund ourselves, to invest in our startups. And this is how the whole idea of putting together the fund came together. But then came Circular 331 initiative, and with the central bank. I don't know if you guys are familiar with what's happening in Lebanon, but our central bank put together a very nice initiative to kickstart the whole venture capital industry, and made available a lot of capital for tech startups and VCs, and that has helped a lot since.
Great, thank you. I think we said we had some institutional investors here in the audience, right? I think, yeah. No. They left? No. Yeah, so we have some institutional investors. So can you tell us, I don't know, who should I direct this to, one of you? Can you tell me a little bit about the difference? Maybe we'll ask Abdullah. What is the difference between institutional investing and angel investing?
Yeah, that's a very good question. Actually, you like to think you want to invest your own money the same way you invest, other people's money, because at the end of the day, you want to make sure that you're generating the strong returns, whether for yourself or for your LPs. But it's very different in the sense that once you've institutionalized the business, it becomes a much more bottomed up organized approach. You obviously have fiduciary duty to your LPs, so you need to make sure that you have the right governance in place, and you have the right reporting in place, and you need the right communication towards your LPs, and give enough visibility on what you do. When you're investing your own money, you don't owe anyone anything, right? You just owe yourself on whoever's your partner you're investing with. But what the main difference, I think, to us, what we've seen, having institutionalized the business, is it allowed us to actually create a brand, and once you've created a brand, and that's the BNY brand, it's allowed us to attract a much more solid deal flow. And having created an international brand as well has allowed us to, I think, better position ourselves for success, because we are today in a position where the good entrepreneurs are coming to us, and we're able to do much more, right? And we also are obviously able to write bigger checks, which allows you also to create more.
Great, thank you. Ghaith, we were earlier on in the morning. We were talking about some of sort of the obstacles, or some of the we could say weaknesses or challenges that we see in overall in the ecosystem. In your opinion, so you guys started this out about 5-6 years ago, and you came from a founder. What would you say, in your opinion, or from your experience, is sort of the biggest challenges we face in the whole investment venture capital world?
Where do I start? I think we've come a long way. To be honest, I think the ecosystem and infrastructure today is much more advanced than it was a few years ago. But I think we still, as investors, we still face a lot of challenges. And I'm talking about challenges as investors, maybe not as founders, because these are slightly different. So because we're investing outside, we can actually benchmark. And whenever we invest outside, we close deals in 1 month, sometimes even quicker, from getting introduced to actually closing. So it's a fast venture, is a fast moving asset class, and it's. I mean, it works this way because entrepreneurs don't have time. These are companies that are burning money, that are burning cash. You cannot wait 9 months to close a deal, because by that time, the company is out of liquidity. So what I'm trying to say here is that one of the biggest challenges we're facing in the region is that it's much slower moving. It's much slower moving because investors are in a different mindset. They take their time. They have less appetite for risk. They care a lot about downside protection, whereas outside they're more focused on upside and alignment with the founders. So that's a challenge. And because we are not big enough, so our first fund is 50 million, and we are not big enough to do all of our deals alone. So we're usually co-investing with other funds, other investors, etc., which are great, but that have a slightly slower sort of process. That's been a challenge, to actually be able to work on the same timelines with everybody. So I think that's a challenge as investors. That's the main challenge. Yeah.
Do you want to add anything, Abdullah?
I think the nature of the asset class we invest in is we're continuously making, decisions with imperfect information. This is, venture is not real estate or private equity where your decision making is fully informed. By the time you get the decision, you've looked at every single aspect of the business and analyzed it, and from a financial point of view, it looks perfect. In our case, more than and Amir said it earlier, and more than 60-70% of the decision comes from the team, right? So in most cases, I can tell you that, Reis and I always discuss this, but, we can have just half an hour with a founder, we know we're going to invest or not, right? It's really about, teaming up with, founders that have the grit and talent and drive to build a large business. It's much more about, is this founder or is this team capable of building a business, that can be large enough to generate good returns eventually, as opposed to, let's look at, the financial model and, what the drivers look like and, what the EBITDA margin looks like in 5 years. And so it's a different mindset to investing, and that's why we tend to move faster than others, because, not that we don't do our work properly, but, we focus on, the metrics that matter to us. And the metrics that matter to us are not necessarily today fully aligned and the same as, other investors who are a bit more traditional in the region.
And maybe I read just to add one point, so because the other thing that doesn't help is the legal framework. Especially in Lebanon, because this is where most of our regional activity happens. I think our commercial code hasn't been updated in 50 years, and so adapting this framework to startups and to what startups need, there's a gap there. There's a huge gap there. So I think there's a lot of work to be done also on basics like legal framework, like the basic infrastructure to allow us to build thriving, startup ecosystems, and that's yet to be done.
Yeah, an example, for instance, to put to Reis's point is, in Lebanon, we don't have an ESOP plan today. It doesn't exist. So we need to
just tell us what that is.
An ESOP plan is an employee stock option plan. Every startup we invest in needs to have one to incentivize, their key hires and key employees, with equity as opposed to just a salary, and that equity vests typically over time, and then that pool of options, when you come to an exit, it will become a very attractive reward for the employees. Every single startup, whether in Europe or Silicon Valley, has one. Lebanon doesn't have, the Lebanese law doesn't allow you to do an employee stock option plan, which is a huge problem to us. So what we need to do is do workarounds, try to, embed in the legal documentations, different scenarios where you mimic an employee stock option plan. But that takes time, to figure out these things. Another example is there's no such thing as a convertible note agreement. And the convertible note agreement or safe agreement, which is today the most commonly used instrument in venture. For those of you who, I'm assuming everyone knows what a convertible note agreement is, right? If anyone doesn't, please. Doesn't exist by the law. It doesn't exist. Companies are not allowed to lend in Lebanon. And I don't know about the rest of the region, but if they don't own 20% of any businesses that they're lending to, so that also is a big problem, because a convertible note allows you to put together an instrument, advance money to a company, allows them to keep on focusing on execution as opposed to wasting 6 months of your life trying to shape another round, and which distracts you away from what you're supposed to be doing. And so a lot of different things like that, to Reis's point about legal framework, that need to be also addressed in our part of the world before we can consider venture as an asset class, a mature one.
Well, that's great that we're going to later on have a session on legal with Patrick, who's there in the audience. If you can wave, and then we can maybe pick his brain about this question even more. But despite these challenges, right? So you're saying that there is legal. You're working around that, being able to get investors that are on the same wavelength when you co-invest, and then continue to raise. Because you need to be able to help the startup, even if you invest at pre-seed or seed, as they continue to raise funding. You were saying that you were able to attract the best startup or really good startups. Maybe Reith, you can tell us, how does the deal sourcing work? We talked about networks, and each one has a different thesis. How are we, from your point of view, how does deal sourcing work in the region?
In the region.
In the region, and then maybe you can tell us a little bit. Maybe Abdel can say about.
When we first built BNY, I think what we wanted to actually build in terms of venture capital business, we wanted to build because of our experience as founders, and because of our experience raising money as founders as well. We wanted to bring like a fresher approach to VC in the region, and so BNY was built as a founder-first fund, first and foremost, founder-friendly fund, which means that and again, this is not to say that other funds don't do things well. I mean, these are different approaches to investing, but we're lighter in terms of terms. We try to find a lot of alignment with the founders, so we're less strict on, let's say, protection, on minority protection clauses, etc. So we try to align ourselves with the entrepreneurs as much as we can. So I think that founder-first reputation really helped us attract the best founders in the region, because founders want to work with investors that are fully aligned with them. They don't want to feel that these founders, are here to squeeze them or to take control or etc. I think alignment is extremely important, and that's one aspect. I think the other aspect is, I briefly touched upon it earlier, is once you invest, you have to add value. I mean, adding value, a lot of old VCs say we add value, and I think we have amazing VCs in the room. We've worked with everyone here. I mean, Beko, MEVP, and WAMDA are fantastic VCs. These guys add value. So I think adding value is really moving the needle for the founders, not taking the founders' spot. I mean, you have to be in support, but that's really important. And by adding value, basically giving the founders access to market, helping them figure out product, marketing, fundraising, connecting them to the right potential customers, etc. By doing that, I think this is the best way to build your brand and then get deal flow. So by being founder first and by adding value to the founders we work with, I think that's how most of our deal flow comes to us now.
I think maybe I can add one thing. 100% of our deals, we have 29 companies today in our first fund portfolio, and 100% of those deals were warm referrals. Like people, founders networking their way to us as opposed to us, chasing deals. And the reason that's worked this way for us is, just as I just mentioned, is, I think we've built a very solid reputation of being a founder-first fund and helping our founders with, different things such as go-to-market and business development and access to our markets, etc. But, and then what happens is, the good founders, as I said earlier, speak to the good founders, and the good founders would recommend us to the other good founders. And we really build very strong liquidity within, a global founder community today that allows us to source our deals.
I want to ask a question. I think Yusuf mentioned this earlier, that right now in the region, it's the investor's choice, right? So you're trying to find those best deals. So in your experience, would you agree with that point, or how have you found it since you started?
You mean
in terms of sourcing deals, and is it there's an abundance of them?
Less competition on deals?
Yeah. There's a high competition in getting those good deals, so that's why.
There's high competition on the good deals. There's a lot of not so good deals, and that are not venture backable. And it doesn't mean that we don't work with the entrepreneurs who are not backable to us. We tend to work with everyone, even if a founder comes in and we feel that they're not ready for us. We would, support them and help them, become investable. We would help them, take the right direction for them to become, investable for a VC. But in terms of, competing on deal flow, I don't feel we've been competing with any of the VCs on deal flow. There's been a very good collaborative approach. We've been co-investing with everyone. The good founders, as I said earlier, are, getting to the good VCs, and different VCs bring different things to the table. So, for instance, we've recently done a deal with Beko where we're bringing, difference to the vehicle. They have, access to markets we don't have access to. We have access to, markets such as, even Western markets. They don't necessarily operate in, although they do have access to. So what we've seen is very good collaborative. I don't think all of the VCs that are here we have co-invested with. So when it becomes competitive, I think it becomes destructive. like to look at this as, more of a collaborative approach, and where, everyone can bring in, a different set of, value to the table, and then if we all work together, we'll do much better.
Okay. Ghaith, I wanted to ask you, so he's saying it's very collaborative, and then you guys are all investing together and you're helping each other. So maybe some people here who are considering this, or as an LP, if they're going to invest in BNY or as opposed to anything, how do we mitigate the fact that all of a sudden I'm an investor and then I have so much exposure in one startup because all of you guys are investing together? Yes.
That's a great question, and this is this is a discussion we were having actually with our central bank in Lebanon, because we're a handful of funds in Lebanon, and there aren't too many deals. So you have a lot of different companies and startups attracting money from the same funds. But my feel around that is that most of the good companies are actually picking their investors in terms of fit, in terms of who can help them, who can add value. So we would not basically increase the number of investors on the round just to have more capital. The way we do it is we think strategically. We think, for this company, who's the right investors? This is when we're leading. This is how we approach investors from our network. For instance, like Abdullah said, for instance, on Mikey, we co-invested with Beko because we believed, there are a lot of synergies there. So I think it's a question of putting the right mix in the round, and if the right mix is there, it adds value to the company. I think if it adds value to the company and the company can benefit from that presence of multiple investors, then it makes sense, even if those investors are across stages, as long as different investors are adding different value to each company. I don't think it's a problem. I think it's a win-win.
I hope you agree, Abdullah, because then we'd have a problem here.
No, I do agree, and also, many funds are not operating at the same stage. Some funds are earlier, some funds are, we've done in the region, we've typically played in the later part of seed. And also and a lot of our companies, once they've matured, have attracted money from others, from MEVP, from Beko, Leap, etc., Leap Ventures, etc. So also having an ecosystem that's well built, where most stages are covered from existing players, it can be also very healthy. And because different stages, different funds that focus on different stages, obviously bring different things to the table as well.
And Arish, just to add one more thing, and what I think resonated well with our LPs is the fact that we're investing also outside of the region because of that exposure and diversification. I mean, at the end of the day, LPs are looking for returns, and by giving them sort of a platform where they can actually invest in a mix of deals that are regional plus international and all high quality, I think that resonated well. So that diversification is important, and in our case, it helped us to be global.
Great. Before I open the floor to the audience for questions, because I feel I've been talking a lot, I want to give them a chance to ask you. In terms of investing abroad, so you said that it's important for your LPs to see that kind of diversification. My question to either one of you would be, is that how does that sort of add value, because you mentioned to me this, maybe not on stage, but when we had a discussion earlier, how you wanted to sort of give back, to the region, give back to your country. So how does, going and putting your money in a company outside add any value here? Anyone or both of you?
Yeah, we can do it together. Maybe the best way to answer is to give you examples, right? So as I said earlier, giving ourselves that ability to invest outside has created a lot of externalities for our portfolio companies in the region, but also for our ecosystems as a whole. And one example would be a lot of the companies we invested in Europe and in the US are slightly more advanced and in terms of stages, and the companies that are doing extremely well in their core markets, and they're 100% of the companies we invested in are exceptional founders. So we've been able to actually bring some of this know-how back into the region by having our founders work together. So a lot of our founders in the US and Europe come to Lebanon to coach and mentor, our our founders from our portfolio companies here. So there's a lot of knowledge that can be shared and a lot of best practice that they can capitalize on. That's one. Another example is, we built a company from Beirut from the pre-seed stage onwards, and it's a company that went on and raised, a seed round and then Series A round and became, Series B investable, at which point, because we built an international network, we got one of our, very fund we work very closely with in the UK that typically does, Series B, and whom we've been working for 5-6 years. So there's a good element of trust between us. We've co-invested on their deals. We said, hey, have a look at this company. It's Beirut-based, but it has a global, sort of offering. And then they looked at it, and then they ended up doing the deal, and it was their first actually deal outside of Europe into a Lebanese company. So that also has been extremely helpful. Basically, building our brand internationally has allowed co-investors that trust us outside of our region to look into our deals and say, these guys must be doing something right in the region as well. Let's look at what they're doing. And then they find out that there's actually some very good companies in our region too that can become global companies and that can compete with the American and European companies. So that's another example. So teaming up our founders is one. Attracting money from abroad into our portfolio is another one. But also a last example is, we have actually currently 3 companies that are fantastic companies at Series B stage that, are in a very good trajectory for a very large outcome in their core markets, are interested in the Middle East. And we're currently working with them on setting up shop in the Middle East, in Beirut or in Dubai. No, so far it's been Beirut, this is where we are. But so they're open to setting up like shop and presence in Beirut to service the region. So there's tremendous job creation as well that's coming from our ability to invest outside. And these companies we're talking are companies that are growing double digits month on month. So that they come into the region and they set up an office to service the region. They're hiring 10, 20, 30 people, doing high-tech innovation, driving the economy. Is also super helpful to how to build the ecosystem. So there's like 3 examples of how we've been able, just our ability to invest outside has benefited our local ecosystems.
Maybe a 4th example is, so the last case is some companies, so the companies we're working with outside are interested in the region, and at the same time, the large corporates in our region are interested to get access to innovation that's outside. We have some great companies in the region, but we also have, some valid opportunities outside for our corporates to team up with. So to give an example on that front, for instance, we invested in a company that's based in Sweden called Soundtrack Your Brand. This is a B2B of Spotify. So it's actually a spin-off from Spotify using music streaming services for businesses. So that's a company we invested in at Series B that we're supporting very closely. They're interested in our region because they're service retail and there's a huge retail market in the region. So we've been helping them develop their business in the region. We've introduced them to a few groups in the region, and today they're working, for instance, with Level at Shalhoub, which have adopted their technology. Shalhoub is very happy because they're adopting an amazing product that can help their business. We are happy because we created value for an international company in the region. So I think this is the 4th element: is helping companies bring that innovation back to benefit our local environment.
Great, thank you, Abdallah and Ghaith. I'd like to open the floor for questions. No? Were they that good on stage? I'm sure there's a question out here. There's, okay, over there, Alex. If you can just introduce yourself as well, please.
Europe and Southeast Asia, also active in the Gulf region. As we also have similar experience of trying to be active in sourcing and portfolio management across different regions, could you tell us more about how you are managing this, or how you're finding companies, how you're supporting entrepreneurs across different countries?
So I didn't get the first part, can you...
Could you tell us more about how you are managing sourcing, pipeline, and then portfolio management, and adding value to the businesses you're investing in the Middle East, but also globally?
Sure. So basically, I think maybe Reis and I like to think today, we divide our job today into 3 buckets. One of them is sourcing and doing investments. The other one is doing portfolio support. And the third one is, building our network and continuing to, meet and meet great people and great investors and great founders with whom we can work to, continue expanding our offering. On the sourcing and doing deal side, it's been very organic. I think the key there was to build a brand that resonates well with the founder community. And, initially when we started doing this, we thought that, the deals would come from the co-investors. The co-investors who know us, who trust us, they'd send us deals. It doesn't work this way. Quickly we realized that actually 99% of our deals today come from our network of founders. So the good founders we work with who recommend the other good founders. And that's worked really well for us. And how we can attract deals from founders is just by delivering on your promise. I think we've executed very well on our founder first promise to founders, and we've supported our founders quite well in along their different efforts. So which has given us the right reputation to that. So that has been really, really key for us, and I can tell you, like, we invest in, across the globe. We haven't done too much Asia, but we've done Middle East, Europe, and US, and we get hundreds and hundreds of deals into our inboxes, and so we haven't had any problem with sourcing, and all of it is organic, all of it is warm referrals, and most of it comes from the founders. In terms of, that's first part. And so our last 2, just for the record, our last 2 investments are introductions by Emma. Thank you, Emma.
We'll talk to you later, Emma, and see if what they're saying is true. Okay.
Yeah. Then the second part, and that's the portfolio support. We have 29 companies today that we support. Well, Reis and I are not alone. We have a team of 7 who helps, quite significantly as well. And then, depending on the stage the company is at, we do different things. The companies at, the seed stage, our support would be, meeting once every 2 weeks to think about product, think about, what the market's saying, helping the teams, loop the market feedback into the product development, thinking about go-to-market, thinking about, capital requirement, thinking about fundraising, all of these things. Especially when the company is early, we spend a lot of time. And our experience as operators and as founders helps a lot. So we've been spending a lot of time doing that with our founders at the early stage. But then when the company is more advanced, and these are typically the companies we invest outside of our region, our support is mostly introductions. So introductions to the large operators and large industry groups that are relevant and matter. Reis just mentioned Soundtrack Your Brand, introductions to Majid Futem, introductions to Azadea Group, introductions to Shalhoub Group. These are all leaders in their space, and once you get them on board, it can significantly influence the outcome for these startups. That's something. So we also have 10 banks as ILPs that help a lot with portfolios. A lot of our fintech companies, we have introduced to our banks, and we're running pilots, etc. So that's with the later part later stage of our portfolio. And then the third element is the network. And basically, I think Reis and I spend probably more than 50% of our time is traveling. We have to have an amazing team in the office to be able to do the execution because we're not there doing most of the execution, but we're spending our time in London, in Paris, in Stockholm, New York, in San Francisco, in Dubai, trying to, build the right connections, build the right network of founders, but also build the right, network and connections with the top VCs, such as Amir, such as Chris, Walid, here in the room, but others also abroad in Europe and the US. So roughly, I don't know if that answers your question, but this is like, I've given you a quick summary of what we do and how we spend our times.
Great, thank you. Unfortunately, you see Lemis over there. If you can just wave your hand, Lemis. She's getting mad at me because I've run over time. So if anyone has any more questions, we're going into a break right now, so I would encourage you to come up and speak to Abdullah and Ghaith. But I wanted to thank you both for coming here. And it's the first time in Bahrain, so we have to hope that we've given them a warm welcome here. And please enjoy the break. We were supposed to start about 10 minutes ago, I think. So if I can get everybody back in the room in about 15 minutes, so 20 minutes, so 12:30, if we can have everyone before we start the panel discussion. So thank you so much, Abdullah.
Thank you,
and
thank you. It's a pleasure. Thank you for having us.
Myself, I grew up in Dubai, studied computer science in the UK, and worked in venture in 2005 in London. Moved back to Dubai to start working in venture in 2008 when nothing existed. Ended up working for the government of Dubai to launch a seed fund, and then started a couple of companies in both finance and strategy consulting, as well as a few offline businesses, before teaming up with my cousin Danny in 2012. We invest in early stage. For us, that's seed and A predominantly. Regional, for which we consider Lebanon, Jordan, Egypt, and the GCC. We've made 22 investments. The 3 most successful ones so far in our portfolio are Kareem, Property Finder, and Fetcher. And we have a whole host of emerging companies that we're excited to be supporting. So.
Thank you.
Hello everyone. Good afternoon. Mahmoud Adi, founding partner at Shuruq Investment out of the UAE. So Shuruq is an early stage venture capital focused on the region. Quick background on myself. I'm a mechanical engineer by training. I'm from the Petroleum Institute in Abu Dhabi, then MBA from Stanford. Worked in the Silicon Valley and in Abu Dhabi in one of the sovereign wealth fund called Mubadala. And today I'm at Shuruq.
Yes, hi, I'm Abdullah Yafi from BNY Venture Partners. For those who weren't here earlier, maybe just a quick condensed version of who I am. Well, I'm formerly a consultant. I built tech products for a long time at Accenture in Paris, then moved on and became an entrepreneur. And as an entrepreneur, was fortunate to build a couple of companies, one tech and one non-tech, and was fortunate to go through the whole cycle of building companies and raising money, but also exiting companies. And 2015, with my brother Reis, we teamed up and raised our first fund, 50 million in size. And today we invest either early stage in our region in MENA, and typically later part of seed is where we invest, but we also invest in Europe and the US at the early growth stage, so typically Series A, Series B.
Thank you. Thank you everyone for the introduction. And I just realized that I never actually introduced myself, so I'm going to try and do this right now. So my name is Arij, and I head the development services at the Bahrain Development Bank, and which includes the program Rawad, which supports entrepreneurs and has different programs which include this Invested platform. And more recently, I've been assigned to take lead on the fund management for the Al-Waha Fund of Funds. So thank you everyone once again for joining us. My question is to Beko, Lumia, and MEVP. So you guys are all VCs and you're based, so Beko and MEVP are based out of the region, Lumia is out of the US. How would you say that, amongst yourself with your partners, do you set your priorities and outline your thesis? And how important was that initially when you started, and how has it changed as you've evolved? Because all 3 have been in operation for quite a number of years. So I'll take the volunteer to start. I'm going to pick on Chris.
Okay, I'll volunteer. First of all, I'm looking at the audience, and I'm just going to encourage those of you that are trying to stealth use your mobiles, go ahead and put it up above the table, because it doesn't bother me at all. I love it, in fact, and it shows that this is a aggressive, smart group. You're multitasking. And I'm going to be bored by a couple of things set up here too. I kind of wish I could pick mine up. So just do it. What was your question again?
Okay. All right, Chris. I don't know if I should have chosen him first, but anyways. So, you've been in operation for quite some time. You and your partners, how important is a thesis, your process, and how has it evolved over the years?
Yeah, it actually is, it's very important to have a thesis and a process, in part because it gives your investors comfort. I mean, you have to be able to tell the story. And we heard some interesting differences of opinion earlier about whether a firm should be global or local. And I think, in fact, all of the firms, as far as I know, have successful track records. And so it isn't that there's one answer, but you need to pick your answer and follow it. It helps you shed a bunch of deals that may come in, may be good deals, but can't be done according to your thesis. I think you were talking about the amount of deal flow that we all get. It helps you give comfort to your LPs, but also helps them direct their allocations. You have to assume that they have allocations for a reason, and it isn't just venture in general. It may be, I have an EM allocation here, I have a developed market allocation here, I have a fintech allocation here, so you have to be supportive of them with your thesis. And of course, you also have to believe that it's a space for growth and high returns. It has absolutely morphed over time within Lumia, as well it should, because technology changes really rapidly. And what hasn't changed is sort of our value add. And since value add is how you get into the best deals, that is the one thing you need to sort of not only settle, but also develop over time as a fund.
Great. Amir?
Yeah, I think ours was very much a learning process. So we started off, just like I said, Danny and myself, investing. We tried to be process-driven when we first started writing our own IMs, going through a funnel in terms of deals, screening, and everything. And then we learned about the value we can add as a team. I think that was something we learned. So we spent 2 years doing that. When we launched our fund, we tried to institutionalize, let's say, version 1.0 of that. And we've constantly tried to find ways to make our process much more efficient, both from a decision-making perspective and then from a value creation perspective. So let's say the first phase of our fund, our evolution, was more on the decision-making. In the past few years, we've tried to institutionalize how we add value, because if it's just reliant on each one of us individually, it becomes a bit more challenging to scale. So, we spend a lot of time thinking about that. When it comes to thesis, investment thesis.
No.
Okay. Am I boring you, Chris, already?
Maybe.
So it's so early that we have to be opportunistic. We don't invest in certain sectors like hardware or gaming, but everything else, we take a very stage-focused approach. And it turns out a lot of our investments so far have been Dubai-based companies, but we're regional in nature.
Sure.
So when we started, the idea was that in the Middle East, the Arab world in particular, companies could not find equity to scale. SMEs could not find equity to scale. And that was more relevant for the software/internet businesses. And then as the adoption of online and internet and software businesses happened, this whole digitalization, we started seeing multiple waves. So in the beginning, we invested in a whole bunch of new media companies, and then we moved on to investing in a bunch of marketplaces and on-demand businesses, and then now we're doing a lot of stuff on AI and software as a service and going into the B2B side. So the thesis, overarching thesis is that there is a digitization wave, and below that you have flavors that change, and they will always change. On the processes side, I think the more you grow, the more you are able to attract sovereign wealth funds and people, platforms such as yourself. You have to prove that you can scale your processes and capabilities, and that becomes crucial. So governance and culture, company culture, governance, and the ability to delegate and run a business at scale becomes very important, which is, I think, what we spend a lot of time on. I think the thesis of the region adopting technologies is clearer now as we leapfrog certain infrastructures. So the internet and software and all these companies become, for some governments and companies and individuals, a faster way to achieve a certain goal. And that's what makes this industry very exciting in this time and place.
Great, thank you. I mean, we gathered earlier on today that we have some institutional investors, we have some people who are angel investors, some people who've just set up their VCs. My question to Bernard, Mahmoud, and Abdallah is, how efficient is the venture capital market? And so, you know, you guys all started, some of you have a background where you were entrepreneurs, you started your own companies, some of you working in family businesses. When you started this, how comforting is it for us to enter this space? And, you know, can I look up, you know, the research and get all these statistics? And so can you shed some light a little bit? Maybe we can start with Bernard from your perspective out from Europe.
Yeah, we've been around for 17 years, and we've had, each and every year has been fascinating, and we've seen so many great companies and sold some of those companies. So VC is contributing a lot to the economy of the countries where we operate. And I think we can say that we are actually changing our lives. And because we build companies that would not exist without the capital that is put and cannot be brought by traditional means, then we are actually enabling those companies to conquer and develop new usage, new technologies. Our model is based on deep technology, so we work very closely with academic backgrounds and universities and research institutions. We work with entrepreneurs, and particularly repeat entrepreneurs, and we work with LPs. And these constant interaction enable us to actually define very precisely the areas where we want to create and build the businesses. And over the 17 years that we've been operating, there is not a single fund that has been through major difficulties, because the barrier to entries that we're building in each and every company makes it a very valuable company. And the needs that they address, particularly since we've been focusing on fintech over the past 4 years, are in many cases universal needs. A need of a bank in Europe is very similar in many cases to the need of a bank in the Middle East. And that is what is interesting. We're talking about small companies, few employees, and they can already have international ambitions. That's something I find very fascinating in the business we're in.
Thank you. Mahmoud?
So you asked the question about the efficiency of the VC, right? We have seen from the discussion earlier this morning that venture capital, they tend to look at capital efficient sort of startups, right? And the idea is you want to put dollar and you want to generate a tremendous amount of value. That's why we look at sort of light asset models, right? So from that perspective, the VC is quite efficient. And there is no sort of incentive for VC to kind of continue to fund a company and give them a life if they think that the company is going nowhere, right? So the kind of check and balances and the way that the VC behave, or let's say a rational VC behave, it sort of push the thinking to be quite capital efficient. Now, there is also another perspective for the question about the region and the efficiency of the VC in terms of process. Finding information, learning about how do you want to size a market, like how big is the potential growth of the company. Just looking at the data that we looked at it this morning, this data was not available 10 years ago, right? And we see a lot of even companies that are stepping in and trying to create a business model around creating efficiencies. So there is definitely an area of improvement around data and the ecosystem. There is an area of improvement around legal structure, etc. And we will have a session later today to address that. Learning the kind of the optimal structure and how, like, if you are in the UAE, there are ton of free zones, where you want to set up, how you want to set up, like how you want to do the ESOP that was discussed earlier. All of those things, there is no kind of playbook that you can take it and figure out how you're going to do UAE, then Saudi, and then Egypt, etc. Right? So there is a lot of inefficiencies that could potentially improve. And as those improve, we would see the result that all of us are hoping for, that the ecosystem will develop and mature and more capital will come to the region, whether from within the region or from outside the region.
Abdallah?
Yes. To your question, you specifically, because when what you're saying is a number of people are venturing into the space and trying to explore, investing into venture, something that a lot of us didn't necessarily do in the past, but looking at to do today. And I briefly touched upon this earlier during the earlier discussion. I think because venture capital as an asset class, if you look across the globe, hasn't generated too much returns, right? You have to face it. And Walid said it earlier, the top percentile venture investors are generating most of the returns. So if you new into that asset class and you want to make money, you might as well look at where the money is being, where the returns are being generated, and maybe team up with some of these guys that do it. It's very difficult to make money in venture if you're not doing it full time. It's very difficult to get access to the right deals if you don't have the right network and if you're not doing this full time again, right? So, and that's something that we have seen, and we work with at least 5 or 6, family offices who've tried to do venture capital on their own and who all failed at it. The reason they failed is although they're fantastic investors and they get it, they just don't have the top 1% access that some of the VCs have. So my recommendation to everyone here around the table who's trying to venture into that space is find yourself a couple of good teams around you that you trust, and you have many here in the room, and and start a conversation around how you can contribute to their portfolio, how you can contribute to their existing investments, but also new investment. And with time, you start building expertise and credibility, but also to start building reputation and access. And what we've done, for instance, is on a lot of our deals where we get more allocation than we can handle as a fund, we syndicate a lot of the available amount of money that we have. For instance, if we have a round for one of our companies that's 5 million and we're only taking 2, but we can get 3 into the deal, we go to our friends and LPs and people around us who are interested in doing direct, and then we'd offer them, a 200, 300, 400K ticket, and to get them into these deals. And once you get into the right deals, and start generating the right amount of traction on those deals, and the right, reputation around you being an investor in this asset class, then it becomes much easier.
Right, thank you. Chris, you mentioned in your answer earlier about value add, right? So, you have to make sure that you're able to add value. So this is quite, for me, a buzzword, So I keep hearing people saying, we have our value creation team, we're adding value. What does that actually mean? And how does, in your perspective, an investor or someone who's a VC actually add value? I mean, is it just like, you put a team together and you say each one is specialized in something? Can you maybe shed some light or give us an example?
Well, sure. For the big company that begins with a C that everybody's been talking about around here.
I'm waiting to get some. I want to release some news here, Invested, live stream about that maybe later.
That's right, we're live? I won't use that example then.
No, come on.
Okay. So we were relatively early investors, first non-GCC investors there, and I've been close to that team for a while. Specific value adds, which you wouldn't necessarily expect, but let's give you an expected one. They have 30+ relationships with mobile carriers. It's the key to their business. If you didn't have a smartphone and they didn't have drivers with smartphones, there'd be no ride sharing. Those contracts have broad sets of provisions that go from rates and location data and all kinds of things. When I show up there, I skip the CEO sometimes and go right down to the guy that has all those agreements. I have a deep carrier background, and we go over them, and we talk about which ones are relevant, what points we need to do, what we need to change in them. That's value add that their other VCs don't have, but we do, and we bring it. I've grown a big company. That founding team has not. They are extremely driven to the benefit of their employees, and so they're torn as they sit there and say, well, this person who was leading this group of 3 is now tasked with leading a group of 300. They're out of their depth. How do they get their mind around that kind of growth? Well, again, they don't have another person in their stable of helpers who can walk them through the mental challenges and the experiences that I can do. That's just value add. They were looking for global capital. We happen to be sitting in a hotbed where tech investing happens globally in San Francisco. We introduced them to their first big global capital check, Rakuten, to follow up on that because they needed internal resources to sort of build that relationship set. We sent them our VP, who then ran their corp dev group. That's pretty specific value add. Now, right now, not because I'm releasing anything, but go read the paper. They're in play. They don't have a lot of people around them who have done multi-billion-dollar deals. I spend a lot of time with them right now, talking through that process, board governance, negotiating. And so that may be somewhat intangible, but it's specific value add that we bring that maybe others don't bring. Others bring other value add.
Great, thank you. So my question is to Bernard. So, Chris was just talking about value add and how they can specifically add value. If I'm an angel investor or I'm someone who really wants to enter this space, and you've been doing this for over 17 years, if I can't add value, what would your advice? But I want to enter. I want to be able to invest into this company. What would you advise me if I came to you?
If you were an angel investor, I would recommend you actually target a market that you know particularly well. And if you know it particularly well, maybe you want to sit on the board of a company and not just invest in the company. And we actually do that in each and every company we build. Even at the very beginning, we attract valuable board members to represent the company outside of its internal organization. And that is critical to do that from the very start, to implement a good governance even at the beginning. And what we do is we connect researchers, scientists, with repeat entrepreneurs, and also with LPs, because we identify needs where we think we can build great companies. So as an angel investor, I would recommend, and we would be happy to have you invested in a company if you can actually bring something to the table at each and every board, maybe this connection or industry expertise, or you're able to actually see the kind of contracts that can be and assist the managers.
Okay, but if I can't, but I really like this company, what would you do? What can I do? I want to enter this.
If you have a good connection then with the founders and the company, then maybe you stand a chance to get in. Otherwise, it may be more difficult.
Can I just jump in on this angel thing, because I know we've been talking about it for a while, and having been very lucky early in my life, I've angel invested and I've seen a lot of angel investors, and I think the first thing you need to do is go back in your head and say, why am I doing this? Does this fall into the bucket of the same reason I bought that Ferrari? Does this fall into the bucket of some friend or family member asked me to get involved? Or does this fall into the bucket of specific part of my portfolio allocation driven by IRR? And by the way, it's rarely that one. And if it's that one, then you better know a heck of a lot about this company, and really you shouldn't be doing it for that reason. You should, as other people have mentioned, team with people who do it full time, because that's how you're going to get the IRR return. If you're doing it for those other reasons, then I would say that's fine, but please recognize your limitations, because very rarely are you giving any value to that founder, but very frequently do I see over-involvement because they think they do.
Great, thank you.
I could add an example. We have one of a major e-commerce site in Europe, and the founder actually started investing in many, many companies, and then we met him, and he eventually decided that it was a good strategy for him, because he's still running the business, to invest in our fund and have, by delegation, several investments in many companies.
Okay, great. So we heard, again, another buzzword, deep technology and AI and robotics. So, Walid, I'm sure you've probably heard a lot of people who want to enter this space. So, I have no background in any of this, but I want to invest into these companies. What is your general view about people investing in a sector that they don't know? And if I really want to enter the sector and I want to, let's say, diversify my portfolio, I want to be an early investor in that C company. I want to be in that same situation like Chris was saying. How would I go about that without, losing myself in that space because I just don't understand it?
تعرف المثل اللي بيقول أعطيه خبزك للخباز? Okay. Yes, so commenting on buzzwords, obviously this is, it's funny because I've heard the story, I find it to be hilarious. There's a tea company in the US that actually changed its name into blockchain tea company, and all of a sudden its stock went up 3 or 4 times, like for one-day trading. So that's a funny story. Yes, obviously those are words that are used and abused, but I think they mean specific things, and there are specific technologies today that are enabling us to do much more. So I can give examples from what we're seeing. We backed a team of 4 PhDs, math PhDs, that built an engine that understands the meaning of any text in any language, and they went on patenting it, around 20 patents, and now they power the engines of companies, of websites of companies like CNN, like Thomson Reuters, McGraw-Hill, like big tech companies, globally media companies. So where does that come from, right? It's the capacity of very strong founding teams to use specific knowledge, and that's called natural language processing, or AI, or So my point is, you have to understand what you're doing, because it doesn't make sense if you don't have the team, the capability, the experts, the board of advisors. Some of the examples that were presented here are great examples of how you can actually, contribute in the success of a company. You could contribute by knowledge, you can contribute by access, you can contribute by capital, you can contribute by just, I guess being empathetic to the journey of the people who are your partners you're investing with. So, so to answer your questions, if you want exposure in an industry that you don't understand it, I go back to what I just said, just give it to the experts, even if they take 20%.
Great. Amir, you were talking about how you partnered with your cousin, right, to start, and initially you were investing your own money. So I think a lot of people here are either representing their own families or family offices. What would your advice be to them if they're actually trying to set up, or they're trying to venture into that and they're putting their own money? How would they be able to structure that in a way that, builds that credibility that a lot of you were mentioning, and the processes, and being able to engage with top-in-class co-investors if it's just your own money?
Okay, so it's a very difficult question to answer. I think it's context specific, but in my experience, I think we were lucky because at the time of starting, I had about 7 years of experience in venture, and Danny had built one of the biggest regional technology companies or internet companies with Bait. So we complemented each other really well up front, and I think the way we went about it is we sacrificed a lot. It was 18 months, no salary, no income. Your savings is going towards doing these investments, so you're all in. You really make sure you do your diligence on these companies. And we would syndicate it out to a group of people who trusted us just because of our track record as people, right? And from there, we were able to demonstrate that we know how to invest, We were lucky we had 1 out of the 5. That was a really outlier. The rest were not so good, but that one got us to raising our first fund, which was in 2014. And then, I mean, the advice I would give, I guess, is if you want to go down this space, it really is time and effort and practice and dedication, and really spending time understanding the companies you're investing in, understanding the investment process. And we made mistakes, even in our first fund, in terms of not investing enough in certain companies, and it's a constant learning process. But if you're not full-time, you're going to make a lot more of those mistakes.
Great, thank you. Mahmoud, I've been told that, you know, when it comes to investment and venture capital, all VCs are going to come and tell you that they know what's going to happen, and they have the correct formula and the secret sauce that's going to make me money, right? So as an LP or as an investor, or if I'm a family office and I want to venture into the space and I want it to trickle down, how can you assure me that my money is not going to go to waste? And does anyone really know the answer to this? I mean, is it true, or are you guys what they call you, you know, fibbers or liars, as they say?
I'm quite surprised. So one thing that we always kind of share with our founders, we tell them, like, the one thing that I'm quite sure, 100% sure that's going to happen is the plan that you put forward, it will not materialize. That is the only thing that I'm sure. Everything else, I'm backing on a lot of things to go right for the good outcome to happen. So, look, as an LP who is putting, let's say, money into GPs, you are basically counting on a few things, right? One is there is a team who have done investing for some time. They have a track record. They have looked at the volume, right? So they have started to see pattern, or they have seen patterns, and they can tell you, okay, I have seen it in this situation and that situation, and there is high chances that it's going to happen again, right? So it is people who have done volume, and have started to recognize pattern. Second is the thesis. So we talked about a lot about local, global, region, etc., right? There has to be a thesis, right? And the thesis has to make sense, has to add up, right? Backed by data, right? And I'm sure all the VCs, they do spend quite a lot of time figuring out, is the thesis that they started with is right? And there is a continual evaluation for, like, what is happening. Will this thesis continue to hold true or not, right? And the last thing is, you're counting on their ability to find good opportunities or good deals in the market, right? And like a lot of the VCs talked about those kind of the magnet effect. The moment that you started doing well and hang out in the right places and treat people well and back them in the right way and do some of the value add, people will come back to you, and people refer good founders to you, right? If people were not treated well, they will walk away at the end of the day, right? So you sort of investing in a platform that are set up to attract talent, enable talent, empower talent to navigate market conditions that no one can predict, right? But at the end of the day, what we know from history, that in situation where we have back talent, and there were sort of the market, what we call them discontinuities or market inflection points, those talent created significant amount of returns, right? So we have seen that over and over again. And if the thesis is built around those points, I think you can have some assurance that your money is not going to waste. It's going to some kind of good work. And the chances of returning your capital and excess return are higher than just putting your money into other asset classes.
Great, thank you, Mahmoud.
And you should read the disclaimer page as well.
Okay. Abdullah, we were having this discussion, and I think what's very important is, I'm a startup, and you're saying you're founder friendly, right? When is it not founder friendly? And what do you predominantly see happening sometimes when, you know, family offices decide to invest into a company, and these startups sometimes you have no other choice because nobody knows them, they don't have the network yet, and, you know, we talk about it. But let's talk about, when are you founder friendly? What does that mean? And when can you, being an angel investor, be the worst nightmare for that founder? And I'm happy to hear other people's opinion, but let's start with Abdullah.
Yeah, well, first of all, I don't think anyone is not founder friendly intentionally, right? It's not like I'm coming in and, you know, with an agenda that's, you know, bad agenda up front. No, but I think that, you know, investing in venture needs a different type of mindset. And to give you an example, you know, we've seen companies come to us with, you know, maybe one round prior to coming to us, one round from an angel investor with a cap table that looks like this. So 60% belongs to the angel, and then the remaining 40 belongs to the founder and his co-founder. So when we look at this is, to us, it's very difficult to come in and invest in a company that has already given away 60% of its shareholding when it's at pre-seed. You know, founders need to understand that, you know, in order for them to build, you know, very large companies, they need to understand stage financing. Stage financing means multiple rounds of financing and fundraising. And by the time they get to an exit, they need to have, you know, sufficient ownership and skin in the game to, you know, continue working for their investor base and working for their shareholders to be able to exit. So back to your question, being founder first means putting the interest of the founder ahead of everyone else's interest. And when you put the interest of the founders ahead of everyone else, you're creating win-win. You're putting the founders in the right conditions to operate and execute and build a large business. So other founder first terms can be, you know, and you know, a lot of investors in our part of the world, from our experience, you know, approach VC the way they approached a PE investment. To us, venture capital and private equity, although similar in many ways, are very different asset classes. You know, and on one end you have, you know, majority control investment, and when you're approaching a company where you're taking majority and control, you're obviously looking at it from a very different perspective. When you're approaching a company where you're doing minority, even though you're doing significant minority, you know, you're focusing on the upside, limiting, obviously protecting your downside. But what matters to you is, you know, is this founder able to build a large company, and how can I help them get there, as opposed to, you know, what do I do if shit hits the fan? You know, and we find that a lot of the mentality in this part of the world is, you know, what do I do in case things go wrong? You know, we'd rather focus on, you know, what happens, you know, how can I help this company, you know, go and reach its full potential and, you know, maximize its upside so that everyone wins. So a lot of our terms reflect that, and a lot of our terms allow the entrepreneurs to be in the perfect conditions to operate and, you know, build those large companies. So I'm happy to, you know, dig deeper if you want to go into like specifically what type of terms I refer to, but we can do that.
Yeah, maybe offline, or we'll leave it to Patrick when he talks about it in the next session. Bernard, I wanted to sort of just follow up on that. So you're, you know, looking at the region. I mean, you predominantly invest abroad, and you want to bring your companies over here. So what if, you know, you're hearing like a horror story like this, you know, cap tables at 60%, and, you know, how would you just sort of ignore the deal and run away, or are there ways to work around that when you're looking at a deal and that first investor has sort of destroyed, you know, the whole?
It can happen, and it illustrates, someone talked about it, venture capital is a business, and you have to be dedicated 100%, more than 100% to your business. When you go jogging, you have to think about that. So what can happen is an investor is an occasional investor and has something else happening in his life, in his business life, and cannot dedicate the attention to the company, and at this very moment in time, the company has a very urgent need that cannot be fulfilled. So in this case, it may be an occasion that we match the company's need and take over the lead in the capital table. That can happen. But I would say in general, there is a tremendous difference between having a professional VC as an investor compared to having just friends and family, which can happen at the beginning, but you cannot count on it. I don't think you can build a sustainable, international, deep tech-based business on that. At the moment in time, you need a dedicated VC who's going to fight for you, who's going to enable you to be introduced to its network and to meet the success. Of course, not each and every company will meet the success, but at least we're doing the work.
Great, thank you. I know some people, here are also looking at venture, or either want to set up a VC or want to invest with each other from their own money, which some of you have done earlier. My question is to Chris, Amir, and Walid before I open it to the audience. How did you choose your partners? I mean, I know in some cases it's your cousin, but how important is it that you choose that, I mean, it is a marriage, right, at the end of the day.
Not quite a marriage, but it's important to have a good relationship. And in part, I think our partnership, which is small, has a blend of different talents. So I have what I do. We back to that issue of efficiency, we have an amazing platform that allows us to sort through thousands of companies across multiple regions with some machine learning, some AI, keeps track of all of our contacts, all of our meetings, all those things are rated, and it spits out some really interesting companies for us to look at and rejects a bunch of companies without much help from us. That is not something that I was interested in developing, would be able to develop if I wanted to, but my partner, who came from a software development background, loves it, talks about it all the time, bores me to tears with it. That's why I'm here, not there. But what a great step, because I love using it. I just don't want to develop it. We have a third partner who has a consulting background, and he has tons of empirical data. One of the most important pieces of that data, which I think is relevant for this group, I was talking about it last night, was this direct correlation between category leaders in developed markets, venture-backed category leaders, the rate at which they go global, which is meaning the sooner they go global, the much higher likelihood of an outsized venture return. I mean, that's really important data. Now, I have no interest in developing that data, parsing that data, even really talking a lot about that data, but I'm so thankful that we have that data. And so you need to focus, the people on what they do. I think if you had all people the same, you'd be in trouble. And we certainly don't.
Is it because you're cousins, Amir?
No, we were lucky. I mean, the cousin thing, I think, gives us a bond that's unbreakable. I mean, in the first 2 years, we were fighting every day, getting to know each other on a different context. Family is one thing, but then work, different habits, We had a funny story. I mean, well, funny, as in, I'm going to be open here. I mean, we had a third partner before Yusuf joined, came in when we were launching our first fund. And we realized very quickly in the process of working together that he doesn't particularly fit, at least how he came with a private equity mindset. So going back to what Abdullah was saying, and that didn't suit the venture capital space, and we figured it out very quickly in terms of sourcing deals, how he looked at deals, the term sheets that he was driving towards these companies and founders. And so we just decided it was good to part ways. But I guess the point is that it's very hard to find partners. I mean, these guys are brothers. I'm cousins. I mean, they're twin brothers. So it's tough. But I think once you do, it's like Chris said, we're totally different in terms of what we bring to the table, and Yusuf as well. So it's just when you find that balance, it's really exciting. And with the third partner beforehand, it was a bit, you could tell there was a few issues there. So yeah.
Thank you. Walid?
I mean, sure.
He's always going to be the contrarian, right?
No, I mean, I agree for once. That diversity is first intellectual diversity before it's other type of diversities.
I think building a team that's also incentivized and that's it for the long run and that believes in the same kind of story and mission is also critical. We don't look at our company just as a partnership of people, but you know, as a team that keeps on evolving and getting better. So that's important. But I really don't have much to add to what was said.
Great, thank you. I mean, I could go on. I have a lot of questions, but I'm lucky enough to have access to all of you quite often. So I want to open the floor for questions and see if anyone would like to ask our wonderful panelists. I'm sure some of you are entering this space and might have questions. Please don't be shy and just wait for lunch. Ali? No? No questions? Any questions? Okay, we do. So we have Adil, I think. You can introduce yourself, please. I think we took all the mics, maybe that's why. No.
My name is Adil Hamid. I'm a co-founder of M2G Innovation, which is an industrial accelerator based in Bahrain. I have two questions actually. One of them is, if I was a supervillain and I wanted to make a startup supervillain and I wanted to make a startup unattractive to you, what would be the formula to make it the most unattractive, you know? And the second thing is, if I'm talking to a family business and they've got the different asset classes, if they wanted to start venturing into VC, what kind of percentages and size of investments do you usually advise them to start with? That's it. Thank you.
Maybe on the unattractive question, I think it's so easy to make it unattractive. Like 9 out of 10 will look unattractive. That I would rather answer the other way. What would you do to make it attractive? And if you have a passion and we feel that you're going to fight all the wars that you will meet during the lifetime of the company, then of course, whatever the product and the market, we will be attracted one way or the other. So if we feel that you're bored and you don't believe in it, we will be totally unattracted.
Anyone else?
I don't think there's a one answer for the second part of your question, because it really depends on the amount of capital that they have in their portfolio overall, and then that drives what amount they might want to allocate to venture. I think that you need to have that mindset of risk capital and a longer stage return and this intangibility that we talked about, and you know, usually that is a baby step, and so even if they have massive wealth, if they're not used to it, it probably is a baby step. But you know, funds have different minimums, and firms have different amounts that they're willing to commit. So I don't think there's really a one answer there.
Actually, maybe I can add to that. And because we work with a few family offices ourselves, and what we've seen is, you know, since you know, venture capital as an asset class for the longest time was completely ignored by a lot of the family offices, especially in this part of the world. And so typically you would see, you know, cash, real estate, private equity, and then you have some discretionary mandates with banks doing public equities and fixed income, etc. So traditionally, all of these, you know, big investors were looking at all of this as, you know, how they do their asset allocation strategy. Recently, we've, you know, been seeing a lot of them trying, you know, starting to become interested in venture capital, but because venture is the riskiest asset class, across the board, it's the smallest allocation within the overall portfolio. So we've seen, you know, some groups go all the way to 5%, and that's considered aggressive in terms of, you know, their exposure to venture as an asset class as part of a overall portfolio. Some of them outside of the region that are more aggressive can go to 10%. But if you're starting in venture and if it's the early days, and because it's the riskiest asset class, you know, go into funds, into diversified portfolios where it de-risks the exposure you have to one company. But
I would say 5% is a decent number.
Maybe I can add a little bit of reach, maybe I can add a little bit of color. So if you think about it from an institutional LP perspective, typically you should not allocate more than 10% to the venture capital, much less than 10%.
Great. All right, I see a hand over here. And over here. Okay, so Alex, why don't you go first, and then we'll follow with John and Isa. Go ahead.
Thanks. Alex Brunet from Finch Capital. Could you tell us about your approach towards businesses, so portfolio companies that may be facing difficulties and are in need of a turnaround?
I didn't understand the question.
Can you tell us about how you manage and deal with portfolio companies that are facing difficulties and may need a turnaround? So is your approach to actively lead it and support them, or do you tend to just shift your attention to businesses that may be doing better?
Maybe I can answer this one. I think it really depends from company to company and the cultures. I've seen companies who, to your point, don't want to spend time on losing, businesses and therefore switch their focus. And I've seen companies who actually try to, put the effort. Talking here about the region, I think that's very. I don't have data to prove it. This is more of observation, gut feeling, that turnarounds are much more frequent just because the path to build talent and path to build a company in the MENA region in the tech sector is different than other areas. There are very specific challenges that haven't been specifically solved elsewhere, and therefore figuring out those challenges and solving them requires super granular attention, and pivots, changes, failures, reboots in the business plan, I would say, in my opinion, are very frequent here. At least that's what we see in our portfolio. We've invested in, since we started, I think, more than 45 companies, and there is a constant change. Market changes, people change, talent changes, technology change, and most importantly, recently, what I've been observing is that if you're embarked on the journey of digital transformation or on the journey of transformation of a specific region, we've been tainted by examples and benchmarks that actually simply don't work here, which pushes a lot of tech companies here to ask the wrong questions and try to solve the wrong problems. Their intention is good to go and solve a big question, but then when you go to solve a big problem, but when they go and address the issues of a certain industry, they tend to ask the wrong question or try to focus on the wrong business indicators, just because they saw benchmarks out there of leading companies that have done things differently, and therefore they spend a lot of time replicating and not necessarily figuring out what that is. There's no answer to what I'm saying. Everything here is different, from the consumer, the talent, the price point, the go-to-market, the strategy, the technology. Sometimes even the usage of certain coding languages is different, right? I've seen companies who failed overnight because they were built on wrong platforms and all of a sudden couldn't scale because they didn't have enough access to the talent in certain languages. And what happened in that company? They went on, they bought another company, they had to get another team, all of that's outside of the business plan, they reintegrated that and rebooted the business. So I'd say it happens and it's very normal, and you gotta be on top of your game to help them navigate that.
I'd add that I consider it part of our mission and assignment business to deal with it. When there's a problem, we have to deal with it, we have to figure out, and we have to try and fix it. It doesn't mean we always fix it, but we have examples of companies that we have turned around and been great successes. We also have companies that we have not been able to fix, but this is part of our assignment. It's not a business, venture capital, where everything goes right at the first time. Not at all. So you have to work hard and fix the problems as long as you can.
But I do think, I just want to reiterate, I do think the founder team, particularly at the relatively early stages, is the key. Because if they are not capable, I'm thinking of one example, we're fortunate to have only 2 impairments across our portfolio. And one was supercharged, high-flying, smart as could be. But the minute he encountered some problems, some plateauing, this was not a CEO who was going to be able to take it any further. He could not operate in that, and so all of the input from the VCs you could bring wasn't going to change that, and so we shut it down and returned the capital. And so I do think it's very much founder specific. Of course, at a later stage, you can replace the team and do things like that, but at these early stages, if the founder isn't up for it, you've got to cut the cord.
Great, thank you.
Can I add to that? Sorry, I've been waiting. There are quite a few panelists here, so. Sorry, Chris, you want to get your phone out? I'll be quick. So our position is that, you know, when we first started, like I said, we made 5 investments. One of them was sort of a 0 outcome for us. And when we found the company going through its challenges, we were quite active. So we went in, we actually changed management with the approval of the founders, with the support of the founders. We raised additional capital, and then we tried to give it another shot. It didn't work, and it failed. I think the other 2 examples that I can think of in our portfolio, we tried to facilitate exits for a couple of our companies when we realized that the founder was kind of lost motivation and energy, doesn't want to persist through the journey. And another case was that they weren't getting the traction they needed. So it depends. I think we're active and we continuously try and find ways to make it work. Just like Bernard said, it's like our job. And if it doesn't get fixed, that's, you know, tough luck for us and the founder.
So back to me, for you guys making it full time, otherwise you wouldn't be able to do all of this. Yeah. Sorry, Isa.
Okay, so Isa Al-Dosri from Bahrain Development Bank. First, I would like to thank you, Arij, and all our esteemed panelists for the very exciting discussion. My question is open to all panelists, but mainly to comment, or I absolutely agree with the fact that Abdullah mentioned regarding the family offices trying to double hat into going to the VC space by themselves rather than investing in VCs or allocating that fund to VCs. So in the region, we currently face a major gap in the market that can be easily filled, which was even commented on Beko's presentation earlier, that these funds easily can be routed through the VC space. So I believe that there is a significant role that number one, entrepreneurs, financial institutions, and VCs can play to assist or help route or drive the attention of high net worth investors or institutional investors in the region, and drawing their attention from the disease we call real estate here in the GCC into the VC space. So what do you think is the main role, other than such exciting panels and forums that these things are discussed, that VCs, financial institutions, and entrepreneurs can play into attracting these funds into the VC space, which is a necessity at this time and more lucrative than taking it 100% into real estate? So the question is open to all panelists.
I'm not going to let all of you answer because Lemis really might murder me. So
I can maybe start, and I'll make it short so that the others can answer too. But you know, a lot of the families in this part of the world who are interested in this asset class don't only have money, but they're also operators themselves. You know, they lead, you know, large, very, you know, leading industry groups across sectors, right? So for instance, in our fund today, we have around 30 plus LPs. Many of them are leading operators in their industries. We have leading banks, we have leading insurance companies, we have media groups, we have retail groups as well, telcos, etc. And all of these, you know, groups who are interested in the asset class can also help us influence outcome for our portfolio. So when we go to them, when we go to those families, we're not going just for money. We're going, you know, in a win-win-win situation, including our startups. We're going to these companies because we feel they can help support, provide, you know, business development opportunities for our startups and help us influence the outcome for these startups and therefore generate better returns for everyone. So I think the angle by which we approach the families we work with is the right one. It's just like we're not going after your capital. No, we're going after your capital, but also the expertise and your industry presence and leadership in your respective sector that can, create that win-win for everyone.
Thank you. All right, I'm really conscious of time, and we want to. The next session is very important as well with Support Legal and Patrick. So I want to encourage everyone who has questions to use the networking lunch to continue this discussion. But I want to give each one of you 30 seconds, and I mean 30 seconds, right, to tell us why we should invest into startups in 30 seconds. Abdallah first.
Start.
Yeah, and then we come to Walid.
Why we invest in startups?
Why?
I personally invest in startups because I'm passionate about investing in fantastic founders who can actually move the needle and who can create value and help transform industries. And I think the future of our economies is in the hands of our entrepreneurs, and they're fantastic people to be working with on a daily basis. And so if you want to help or be part of reshaping the future, then you have to invest in technology and in startups.
So at the end of the day, we are commercially driven people, right? So the venture capitalists are not charities, right? So the reason we invest because there is a financial attractive outcome that we are chasing. But underlying that, why we choose this asset class rather than the others, personally for me, I see a significant impact of such asset class on the region, right? We have been going through a lot of turmoil in the region, etc. And it is like there is no better way to solve a lot of the current challenges that we face in unemployment and healthcare, education, etc., than empowering talented people in our region to solve those problems. So there is a massive social attribute to this, but at the end of the day, we are also driven by the financial attractiveness of the industry.
Yeah, so I fell in love with this asset class when I was 23 years old, and I met the founder of Spotify. He came to pitch to our company.
How many years ago was that?
This was 2006.
You see, I'm trying to get his age.
Seriously? Really? You're doing this right now? So what I saw was just the fact that somebody young and hungry and ambitious was trying to solve something that had a huge impact. So for me, impact's important. The people is like the founder themselves, just supporting someone like that to really go through that journey, because it's one of the hardest journeys anyone can go through, building a company. And finally, just contributing to the economy. I mean, if we look at what we've done today, just on a small level, we have Property Finder, Kareem, and Fetcher. They employ nearly tens of thousands, at least directly employ, and indirectly millions, right? In the span of 5 to 6 years, I don't think you can ever find a sector that can do that in a region that needs it most. So that's why I do what I do.
So I'll try to be shorter. I don't remember which of my favorite twins used the word enrichment earlier in a panel, but enrichment covers a number of different areas, and it's the key word here. You can have, of course, an IRR-based enrichment. You can have a social enrichment, all of these changes, jobs and otherwise. And you can have a psychic enrichment. And if you get satisfaction by other people's success and enabling that, then you get that. So if you can find all three of those, why wouldn't you?
I think it's useful. It creates jobs. It can transform a country. It can transform Bahrain. And you make the future happen quicker, which is fascinating. And last but not least, it is a very profitable asset class in many cases.
I think life is too short. Why not?
Me too.
All right. Well, I mean, I think that, overall, I mean, for me, I don't know about the rest of the audience, but, we heard great points. So if I want to invest into startups, I need to either be able to do it full time, whether I'm an angel or I'm setting up my VC. And if I can't be, I should give it to the experts. I need to be able to add value. So even if I don't understand the company, but I can possibly open doors or help them in some form or the other, whether it's something that they use to help develop their business, but I need to be able to add value. Also, it's the element of expertise. So in your team, having that and being able to be on the same level playing field. And then why would I do it? Is that I have to either be passionate about the sector, I have to care about the impact, and at the end of the day, if I do it right, then I'll be making a lot of money, right? All right, thank you so much to Walid and Bernard and Chris and Amir and Mahmoud and Abdullah. And I know it's very, not typical to have this many people, but I really wanted to bring to all of you to present to you so that at least when we network later on that you got a snapshot of all of them. Now you choose your favorite one to have lunch with. So thank you so much. And before you guys step down and we change the setting, I want to take a picture of all of us together. And so if we can give them a round of applause. Thank you. All right, so up next is the session on by Support Legal, Patrick. So we're just going to do a quick setup change, and while we do that, I'll let Patrick introduce himself and talk a little bit about Support Legal while the background happens.
You have my slides?
Yeah, we do. Just stand here while we set this up.
Hi, everybody. I'm Patrick Rogers, one of the founders of Support Legal. We are a legal services platform that launched 18 months ago on the thesis that the region was about to have its kind of tech entrepreneurial moment, and that founders and emerging companies did not have access to world-class legal advice. All of the people in this room who bring the money in and invest into those companies are able to access, the world's top firms that are New York and London based. Those firms will not take on individual entrepreneurs or early stage companies as clients. It's just a fact. I worked there. Which obviously leads to a serious imbalance when you get into a negotiation with a VC. So we built a model that allows entrepreneurs and emerging companies to go toe to toe with Beko's lawyers, Wamda's lawyers, everybody else's lawyers, because they're our ex-colleagues. And we do it in a very low cost and fixed fee fashion with a heavy reliance on technology to streamline processes, and we think it leads to better outcomes. I think they slotted me for an hour today. I'm definitely not going to take that long. I know everyone's hungry. Me too. So, but it's great because this presentation has been primed somewhat by some of the earlier speakers, some of the earlier questions, and I think people will be familiar with some of the issues we're talking about, but hopefully everyone can do a bit of learning, and please feel free to jump in whenever you like with questions. So that's a bit on us. We are out to disrupt the big law market. Our starting point every day when we come to work is how do we eliminate our jobs, right? So software, the robots, they are going to do that. We just want to get there first. We want to keep moving up the food chain as advisors, and we want to automate and build software around everything else and be the first to do it. We've actually started to turn our firm into a bit of a venture studio, and we brought on a CTO who moved out from San Francisco about 4 months ago. We were working very hard on our first idea over the course of the summer, and we've just spun that out, and we're going to be launching that. You'll see it come out very early next year, billing it as a digital general counsel for tech startups. So basically an artificial lawyer for venture-backed companies run on a SaaS model. It's going to be difficult to do, but we think we can do it, and we're quite excited about that. As I said, our team are all kind of partner level. We all have at least 10 years experience at the world's top law firms. We don't charge by the hour. To a certain extent, we've Uberized our workforce. We have lawyers working for us around the world, from Sydney to Vancouver, with a heavy concentration in the Middle East and the UK. These are people who, for a variety of reasons, do not want to be working full-time anymore. They've either quit to do their own startup, or they're burnt out, or they've just had their third or fourth kid and want to spend more time at home. But they work with us, anywhere from 5 to 20 hours a week. And again, we've built our own internal software to integrate and allow that to happen. So this point has been touched on a lot. And going back to the original slides that Amir was showing, he was showing how much money has been invested into the different countries around the region. And sorry, Amir, but the slides are all wrong. Beko has, to my knowledge, never invested in a company that has been incorporated in the UAE, or in Saudi, or in Bahrain, or in Kuwait. And the majority of the VCs in this room, we can say the same for. The reason is because, frankly speaking, the corporate commercial laws of the region just don't work for venture capital. So as soon as someone actually understands the core concepts of venture, they instantly realize that they will never own shares in a company in the country that they live, and speaking about the MENA region right now. So this is how most founders around the region start, right? They form an LLC or a WLL or whatever it is in the company in which they live and where they are operating from. When they go to raise capital, this is what should happen. So you have the original operating company down here, but as a precursor to raising capital, what the founders need to do is set up a special purpose vehicle or a holding company in a common law jurisdiction. And you'll be familiar with a lot of these names, like the Cayman Islands, BVI, now ADGM is becoming very popular. And it's for the reasons you would guess. In these places, you can have multiple classes of shares. You can be incredibly flexible with your capital structure. You don't have to say, oh yeah, well, each share has to be issued for $1. You can issue a share for 1,000th of $1. Whatever you like to do. You can have share incentive plans. Convertible notes or safes or KISSes actually work and are contractually enforceable. If you need to take someone to court, you can get a quick resolution for relatively low cost because the judges hearing the case actually understand this stuff. In each of these jurisdictions, in where you should be setting up SPVs, there are real intellectual property laws which were written after the internet came to exist. And again, because the businesses that you're investing in don't own big plants and aren't being priced on the basis of the fleet of cars and everything that they own, they're being priced on intangible assets, right? They're being priced on the source code. They're being priced on the public's association and goodwill attached to the brand that's been built. They're being priced on stuff that's just up in the ether, which is intellectual property. All of that needs to be held by a company in a jurisdiction in which real intellectual property laws exist, so that when Kareem is hiring outsourced developers in India or Romania, and they enter into a IP transfer and assignment agreement with that development company, it actually means that IP transferred will be transferred to their BVI company, right? Which is where Lumia Capital and many other people in this room actually hold shares in Kareem. Chris, you don't own any shares in a UAE company, right? You definitely don't. I'm glad Chris is not my father, by the way, and thank you for paying attention to my presentation thus far. So for founders who know what they're doing, right, you get this setup done before you come to the money so that it looks like you know what you're doing. At that point in time, the founders then hold shares in the holding company, and they invite the seed investors to invest at that level. So whether it's ADGM, BVI, Cayman, this is what happens. And again, I've touched on a few of these things, but let's go through them again. I think the example that was just given earlier about the local family office that takes a 60% share of the cap table, and then that cap table 6 months later gets presented to a VC, and the VC says, sorry, too bad, you are uninvestable. Let's try to rework this. Again, if they've if the local family office has taken the shares in the operating company within the country, so in the UAE or Saudi, Bahrain, it's next to impossible to do anything about that if the investor consents, because you have to go and sit with the notary, and then you got to get a trade license update, and you got to get a new MOA stamped. All of these procedures from, you know, super paternalistic laws which don't appreciate the speed at which venture has to work. Right? Going back to the addiction to real estate that's been discussed on, this is all, you know, the laws of the region are stuck in a very old economy mindset where things can move very slowly. It's okay for a deal to take a year, and that's just not the way this works. And I think, you know, the governments are making, I think an awareness is growing, and I think we'll see certain strides made towards ameliorating that, but it's still moving way too slowly, and that's why, you know, people in this room will only be purchasing shares in companies that are not of this region, okay? So yeah, investable structure from the start. You've got clear and enforceable legal protection. So if you agree to something in a contract and it's clear, that is what is going to happen. And if the other person disagrees and you have to take them to court, you will most likely win. And you won't have to wait 2 years for that to happen. You can get a quick resolution at a relatively low cost. And there's no local advantage that an investor might have by virtue of the fact that they live in the place. No foreign ownership restrictions, of course. You can incorporate SPVs in a matter of 2 days. There's no original documents required. You don't have to show up anywhere and sign anything. Everything is submitted digitally in copy format. Just for a bit of regional flavor, and I think a lot of people are aware of what's happening at Abu Dhabi Global Market, which is where we're headquartered. They have basically replicated a BVI company or a Cayman company in ADGM. So ADGM has basically wholesale adopted the laws of England and Wales. Okay, so it's like a little bit of England in Abu Dhabi. It's like a separate country. It also has its own court system, staffed by English, New Zealand, Australian judges who are very well versed in common law principles. You can even do your court case digitally. You don't have to show up there. You can basically do it via Skype. Crazy impressive. But everything that VCs need is incorporated in their law because it's basically the English company's law. So multiple share classes, you want to do drag and tag, put in call options, convertibles work, all of that stuff. And you can incorporate companies very quickly. Our record is 12 hours. From start to finish, we brought 4 shareholders into an SPV in 12 hours. It's quite impressive. It was touched on a bit earlier, the importance of a share option plan. I've got a slide for that in a bit, but just to flag it here, again, totally permissible. And multiple share classes, why do you need that? This is venture capital. At least 9 out of 10 of your investments will fail. So you want some downside protection. Most people in this room are familiar with a preferred return. Okay, so a liquidation preference. So if the company you invest in is just nosediving and gets sold for parts at the end of the day, you might have taken a 1x liquidation preference, which means that the first money out is basically going to be your investment amount. Okay? And then the rest of it will get split up amongst the other shareholders. So it's a downside protection. It's a way to protect your investment. It's not meant to give you an elevated boost if the company is doing well. And if we were talking a bit before about potential abuses of power by the VCs and the power imbalance and people being founder unfriendly, but you can have these downside protections that protect you in the case that the investment just goes completely sour. Yeah. Okay, so we can broadly split the world of VC investing into 2 buckets, right? You are either buying shares in a company, and you will go onto the cap table, or you're going to invest via convertible. Okay? Let's deal with equity financing first. You can see some of the questions up here. Just to highlight a few points, obviously this is a longer process. You have to agree, number one, a valuation, because the shares will have a price attached to them. Obviously that forms a major part of the negotiation. What is the company worth, and therefore what am I paying, what is my price per share that I am paying? Okay? This is fleshed out in a detailed term sheet, which then turns into a subscription agreement. The company and the founders give you a whole bunch of warranties. You negotiate a disclosure letter against those warranties. You enter into a shareholders agreement. The articles have to be amended. There's a lot of paperwork that goes into this, which is why obviously these processes take a bit longer. I'd say, on average right now for regional deals, a priced Series A round, 3 to 4 months, realistically. Some can take a lot longer. Convertible instruments, on the other hand, and I've listed the three kind of main ones there, are much more straightforward. These were invented by the likes of 500 Startups and Y Combinator to allow for very fast fundraising. The main principle being that you are not buying equity today, you are buying the right to future equity in the company. So you have a contractual right, you hand over some money, and you play the waiting game until the company raises a priced round, at which time your investment converts into shares at typically a discount to what the Series A investor pays. Or if you've negotiated a valuation cap, at the valuation cap. So the kind of 4 key points of any convertible are listed there at key terms: valuation cap, discount, whether you're able to get your money back instead of getting shares, and in what circumstances, and how your investment will convert into shares. The advantages I touched on is speed, limited negotiation. Obviously, you're kicking the valuation discussion down the road by doing a convertible. You don't need to agree what the company is worth when you hand over your money. You might insist on a ceiling, which is the valuation cap. You're going to say, no matter what happens, my investment will never convert at a higher value to the company of X million dollars, right? As a lot of people in this room can again appreciate, you don't have to worry about this incredibly lengthy KYC process, which everyone's going through now, if you're doing a convertible, because as an investor, you're not actually going onto the cap table immediately. So founders can get a bit more breathing room to chase all the investors for these elevated levels of KYC, which are now being insisted on. Disadvantages, some that we've seen. I think there continues to be a certain level of misunderstanding amongst investors, particularly the kind of non-VC set, about what they are investing in. And the point's been touched on a few times today that there's it's growing, but there's a general lack of education around kind of core VC concepts that people don't necessarily appreciate, but that awareness is growing. From the founder's perspective, obviously, because you're not agreeing a price today at which the shares are being sold, and it's a convertible, you have the potential to suffer huge dilution if you basically don't stay in line with your business plan or what you've sold to the investors. And from the investor's perspective, if you're investing via convertible, you've got a pretty limited set of rights. So as compared with actually being on the cap table, having a board seat, having a set of shareholder reserve matters that you can enforce, while the convertible is in play, your ability to influence the company or prevent certain things from happening is quite limited. Going back to the point about the importance of offshore holding companies and why no one in this room really owns shares in actual regional companies, IP protection is absolutely in the top of the list. Again, we're not dealing with traditional businesses here that have hard assets that you have to depreciate on an annual basis. This is a totally different ballgame. If Careem is worth $2 billion, it has nothing to do with the hard assets they own. It has everything to do with intangibles. So, where have they registered their trademarks? Easy example, when they first founded the company, I'm sure Magnus Umadasir, one of them, owned Careem.com in their personal name. Right? You got to make sure that gets transferred to the BVI holding company, so that the holding company in a jurisdiction where proper IP protections exist actually owns that crown jewel. Yeah. So again, very important. All of these things, the protection of all of these items, completely lacking to non-existent under the regional legal and regulatory frameworks. Employee share option plans are what we refer to as share incentive plans, and I'll spend a moment saying why we do. It can be a misnomer because you can use options to incentivize a wide range of people. if you're a founder and you're just getting going, you need help from a lot of people, not just your employees. You need help from your advisors. You need help from your directors. You might need help from people who will help you raise money. And you can use options to incentivize all of these people. So, we're making a big push to get people to stop using ESOP and just refer to it as a share incentive plan, because it should be a broader tent. And it's a lot more advantageous if you open that up as a founding team, because you don't have the money to pay people big salaries or incentivize them with cash. So use people's instinct for greed, the potential payoff in the future of hitting a home run with your company to your advantage. So how these typically work is that the board of a company makes the decision to adopt a share incentive plan. They come up with the plan. Typically, they'll have lawyers help them draft it. The board adopts the plan. And then for each individual that they want to grant some options to, the company, which is the holding company, enters into an agreement with that individual. And it will cover off a few things. Let's focus on one or two. Number one, the vesting schedule. People will be familiar with this term. What does that mean? If you promise an advisor 1% or 2% of your company for a laundry list of things he or she is going to help with, you don't just hand over all those options on day one and say, yeah, you can exercise them and go on the cap table. They have to prove that they're willing to put in the hard yards to achieve some of those KPIs and push the company forward. So you might say, okay, I'm granting you 2% of the current cap table, but you're on a 4-year vest with a 12-month cliff. Translation, 12-month cliff. You don't get anything for a year until you've proven yourself. And once you hit that 1-year anniversary, over the course of the next 3 years, you will vest those options pro rata. So maybe once a month, so maybe you have 36 dates on which you can exercise. And so over the course of that 3-year period, you will eventually accrue and be able to exercise those options. Really wrapping up here, and we can go to Q&A and have lunch. Again, we don't put a lot of stock in making money on rudimentary stuff. We think the legal industry is very broken, and we're incredibly focused on turning it on its head and exposing it for what it is in a lot of unfortunate veins. And this is one example of that. So we launched this website, Scale Up, about 12 months ago. Founders can go on here and they can, read very short form articles on all types of topics, from, what is a share incentive plan? How do I protect intellectual property? Why do I need a co-founders agreement to protect me against my co-founders? And then we've also put free automatable documents on here. So founders can create really all the stuff they need to get going. Co-founders agreements, term sheets, safes, kisses, convertible notes, IP transfer and assignment agreements. You don't have to leave an email address. It's all on there for free, and we're constantly refreshing it. The way we've been tracking use of this shows us that there is a growing demand for this content. Up until now, founders in the region who are familiar with the concepts I just discussed, obviously just go on Google, and the info they find is all kind of Delaware-centric. Right? It incorporates a ton of tax information that is totally useless, a lot of terms that don't apply in the region. We have big focus on driving education, not only of the startups, but I think of also the investors and incubators and accelerators. This is also going to be coming out, at least the articles, in Arabic shortly, and is a bit of a precursor to the new legal tech company we'll be launching next year. There's kind of a snapshot of what it looks like. So, this isn't kind of boring legalese. The title of this one, Dear Founders, please note the following, love your lawyers, right? So why it's important to have very clear conversations with your co-founders at the start. Everyone's really excited at the beginning of a startup. You've got this great idea. We've quit our jobs. We've put a bit of money into it. We're going to conquer the world. 3 months in, things can look very different. And people's memories change very quickly. Things get super foggy very fast. We've worked with more than 300 tech startups in the last 18 months alone. and the pattern recognition around faulty memories of some people, you know, is pretty obvious. So, you know, this article is just basically saying, guys, reduce it to writing. You don't have to bring a lawyer in. We've created a precedent for you. We've created a checklist of maybe 12 items that you should talk about. Like, okay, we're building this in the UAE. What happens if one of us takes a job or decides to move home? What happens if we run out of money? Is everyone obliged to put in more money? What if someone wants to hire their cousin? Are we allowed to hire family members? What do we think about our share incentive plan? How much should we be giving up to entice people? I think 10%. What are you talking about, 10%? You said 3 before. 10% is ridiculous. Reducing this stuff to writing early on, you know, is an absolute must. That's it for me. Thank you.
Ask me questions. Any questions? Oh.
Hello, Patrick. This is Shane from Roques Investments again. I have a question for, so all of us here on the investor side, and we do care a lot about this, and of course, investors also need to be educated more on the legal perspective. I also feel that the startups, especially in the region, they also need to be educated further. For example, we come across with a situation where founders are so busy running a business, which is the right thing to do, but sometimes they actually make the company so uninvestable that they need to restructure so much, but they just never thought about that. So they are raising, let's say, 500,000, and out of the 500,000, they literally need to spend 50,000 as soon as they make the investment, as soon as they receive the investment on the restructuring. And no investors are really giving them 500,000, and you just spend 10% just purely on restructuring. You have to use that to grow the business and build the business. So what can we do as an investors, or let's say this ecosystem, to support the startups and the founders realize that, look, you need to think through, and not only your priority is to run the business, but you also need to make the company investable.
Yeah. I think it really comes down to education, and as a collective in this room, for all the stakeholders in the ecosystem, it's our job to drive awareness and education and instill in the minds of founders that the boring stuff, the admin stuff, the legal stuff is important. And you don't get to receive cash unless it's done and looks good. So your product, team, idea could be super sexy, and you never raise $1 because you screwed up the boring stuff, right? I'm looking at Hassan in the background. I was speaking with him and Sharif last week. There's a company that they're looking at. It was the exact example. Like, some dude owns 60% of the cap table and wants to call himself chairman and won't back down. And when it's explained to the individual that, well, you realize that you're going to own 60% of nothing, he's not faced, right? So, but that's so easily avoidable if people were aware of how to avail themselves of free information that explains stuff simply. And if you see the VCs and the accelerators and the incubators and the GREs pushing this information out, ensuring that people get smarter around this stuff, I think that's the solution.
I mean, personally, I believe that's why companies like Support Legal is so important when you work with the startups, because as an investor, I would love to have or check these legal documents as part of a conditions precedent, not the conditions subsequent.
Yeah.
You know, it's just I think it's just the basic standards.
Yeah, absolutely. And I think standardization is a really important point. So, you know, we'll be in a lot of negotiations with guys in this room and girls, and you know, they will say as a point of negotiation, well, that's market. It's total BS, right? No one, like, yes, that might have gone that way in some of your deals, but there is, like, we don't know what market is because it's so opaque. We don't know what people are getting away with, right? When we started doing a lot more work in Egypt, for instance, we were shocked by some of the stuff that the VCs there were getting away with. And we explained to them that, you know, it's not happening that way anymore if we're involved on the deal. So there's still, it's very lumpy in terms of what people can get away with in different parts of the region on the VC side. And yeah, so kind of standardization of documentation and practices, backed by education, and I think you'll see timelines for deal closures come way down. I think you'll see costs come way down, as they should, right? You can't be using 10% of the investment round to pay for stuff, to pay for mistakes, right? That didn't need to happen.
Great. Emma?
Hi, thanks. That was really interesting. Questions have been asked all day about what makes companies investable and how to differentiate. And also, I think there's people in this room who are either angel investors or are thinking of angel invest. So from my perspective and from listening to what you're suggesting to everybody, I hope that this is a reminder that companies that do focus on this, companies that do have good housekeeping, even when they're reasonably early stage, hopefully that is an immediate tick in the box and a really clear signal that you're doing business with people who understand international law, respect investor rights, and have paid attention to stuff which is frankly arduous, annoying and expensive at times, but which pay dividends later. So I think it's, I think when people are looking at deals and however great the company is, if there's a dodgy chairman or a legal document that's not done properly, hopefully it's a lesson to pay attention to those companies that do respect this, because, I think it's a, if your shop window is the things that you think are really important, to founders who want to attract the best investors, this is something I think is absolutely essential.
Yeah, thanks, Emma. Totally agree. And I know a lot of the people in here do when they say, look, I immediately looked with a better light on the founder, because when I asked them for their DD room or access to their DD room, they sent it to me instantly. It was all super well organized. Everything was there. Tick, right?
Great.
I have a quick question. So capital gains, are there any repercussions? I know there are no taxes, but...
I'm not a tax advisor. But if you're worried about capital gains and you're a venture capital investor and that's a real worry...
No, I'm not an investor.
Good for you.
I'm not an investor. I'm a company.
Depends on the country. I don't believe Bahrain has any capital gains taxes at this point in time. I don't, but I don't practice law here.
I understand.
Great. Any other questions?
It seems that I want me to introduce myself. I'm Ali from Bahrain Development Bank. Used to work with Arij. Just a quick question on NDAs and privacy. It seems that there's still a lot of startups that are very concerned about that. Should they be concerned at all? Is there a case where, a startup should actually enforce an NDA for any reason?
I think there are cases where they should attempt to. I'm still not familiar with a single instance of someone actually successfully enforcing an NDA with real consequences. And I think the founders who get hung up on that are a bit misplaced, right? Unless you've invented the internet or blockchain, idea is the easiest part, right? The ideas, we could sit around dreaming them up all day. I got 1,000 ideas today. It all comes down to execution, right? No one is really inventing new stuff. It's either a copycat of something, it's an amalgamation of something else, whatever it is. So we're pretty relaxed when we speak to founders. We say, if it's a specific thing, like you're taking your idea for the tech out to a software development company somewhere else, yeah, I mean, maybe, but the majority of VCs in this room won't sign an NDA to sit down and have a conversation with you. And in our view, it looks a bit foolish if you try to insist that they do, because it just shows that you think ideas are important and ideas are cheap.
Great. Any more questions? Okay, I have to ask you a question. Sorry, Patrick. I can't let you go.
Everyone's hungry. You don't have to ask me any questions.
No, I will. Okay. Why don't you tell us something, what is the most interesting type of terms that you witnessed, here in the region, and how were you able to sort of what would you advise on that? Give us that example and say, was it a good thing or a bad thing? Because we know we always tend to get these complaints that people here don't understand, the terms are crazy. So if you can tell us, I mean, usually investors try to say, yes, I was able to get this many terms onto the term sheet.
Let's use a kind of a Series A round as an example. So something that often comes up is, should the founders lose control of their board, right? So should the co-founders lose the balance of power on the board? Our view is no. Some other people think yes. The founders will eventually lose balance of power, but Series A is way too early. What I talked about earlier, the liquidation preference, some people might try to push for something higher than 1x. And again, if it's a downside protection, let's protect your money. You can get your money back if things go wrong. Don't give me this 2x discussion, right? You're not supposed to be making money if things go horribly wrong. I know there will be differing opinions on that. An interesting one that we've seen of late, I think someone in this room might have put it into something recently, is a prohibition against ICOs, which we've seen, which we saw written into some documentation recently. And obviously with the crypto thing picking up steam, I think you'll begin to see a bit more of that.
Great, thank you. Any more final questions? No? Ah, okay, so now we know who did that. Maybe we can ask him later during lunch. Well, Patrick, I wanted to thank you so much for, taking the time to come here and join us. And, I know you're very busy supporting startups and founders in the region. So, I think it was very valuable to hear that, and it sort of kind of brought to close a lot of the different points that we were speaking about in terms of getting into this asset class, and then being sure that we understand the legal structures behind it. And so, if I'm going to sort of kind of market what you do, but how would you be able to help, let's say, somebody who wants to start investing into this asset class, and how can support legal in your point of view? I'm sure you can't represent other firms, but what can you do to help me as an angel investor or someone that's going to set up a VC, my journey a little bit more, a little easier?
So yeah, obviously we, by and large act for the entrepreneurs and the startups themselves, but we work with a lot of VCs, including some in this room, on different pieces of advice. We help with deal flow. We will do angel investing seminars with some of the angel groups that we have friendships with. We will help some funds actually build their fund structure, whether it's in Cayman or ADGM or whatever it is. So there's a few different ways, but I would say if you're a pure angel, again, coming back to the point of education, there are starting to be resources out there that you can look to get educated. And I know a lot of people in this room, and they're all very generous with their time. And I think everyone has the belief that we have to kind of grow this ecosystem together, and it needs help from all sides.
Great, thank you so much. Thank you, Patrick. Well, except for maybe a few people that might have to have stepped out, I think, time actually for me passed by quite quickly. We spent about, 6 to 7 hours here all together, going through, understanding the region, the trends in the region, all the statistics, numbers, getting a perspective of why two people who were predominantly in the corporate world, working with their families, how they entered into startups, and then with a whole diverse panel of understanding why we invest into startups, and closing back down to how we actually create that structure and protect and understand the legal frameworks when we're actually getting into this asset class. So I hope that, for many of you that are looking or interested in this asset class, have really gained some knowledge and have been empowered by tools that can help you make better decisions and can help you further develop your thesis or your process or your just understanding of why you would want to invest into this asset class. And I know that a lot of people might have had questions and are maybe camera shy. But we have now next up our networking session, which is a networking lunch where if you haven't already signed up your name for one of the tables, please do so. And then when we go downstairs, it'll be on the ground floor. Find the name of the table that you've signed up, and take this opportunity. I think I was speaking to Bernard earlier when he said, we spend so much time traveling from place to place or attending meeting to meeting just to meet some of these people. And so you have the opportunity to have everybody kind of in one room around different tables and take advantage of that, because it doesn't happen that many times a year unless you're really like hopping from one conference to the other. But I think those aspects are quite invaluable in these kind of discussions. And if you noticed, one common thread that every one of these people were talking about is building your network. And so how better to do that than taking advantage of that time. So don't sit next to your brother or your cousin or your partner, but really try to move away from them and sit with people that you've never, spoken to before, and build that network, because you never know when you're going to be able to. You might need Patrick one day when you have a startup that brings you a term sheet that you don't understand. You might need, Yusuf when he's an investor in one of the companies that you might want to write a check to later on. So thank you so much. And one thing that I want to point out before you go down and you disappear is that in your booklets we have sort of some pointers in that notebook about what you should do after this event. So a lot of people come to these events and then tell us, okay, but what am I supposed to do? And so there's a sort of like a checklist that's very basic and might seem very obvious, but sometimes, just putting down like some goals for each one of you as to what I should do after invested. And I see people frantically looking at the guidebook. It's actually the notebook with the spiral. So it's not just a notebook with pages, but there's a lot of information there. A lot of contacts of the people, their websites that have actually presented here on today for you to be able to follow up with going forward. But also, just try to take some of those tips. And, we are here to help as well. And, we don't do this just for fun. We really care about building this ecosystem and building the investors and helping bringing them together. And why do we do this? Is because we really believe that there is that necessity here in Bahrain and in the region itself. So make sure you sign up if you haven't signed up for the table. Sit down, enjoy the networking session, and then we'll have a break after that from about 4 to 6 p.m. And then we're back up here for the evening networking reception, whereby you'll be able to maybe take some of the knowledge you have been presented here today and implement it with the various startups. And we have some startups that are also going to present and talk about their journeys while getting investments in what they do. So thank you very much again to all, Beko, Truffle, Lumia, Shuruq, MEVP, WAMDA is also here today, and Support Legal, and the rest of you that have all, and 500 Startups is also here today. So we have quite a big network all here, and Finch Capital, and if I'm missing anybody's name, oh, the Yafi brothers, how could I forget them? Because they're not sitting in the audience right now, that's why. But thank you all for making the time, to come here and to, basically contribute to the overall development of this ecosystem. And so without further ado, lunch is served on the ground floor downstairs. Thank you.